From bonds to currencies and even stocks, investors in search of a haven. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlet Fu. We're kicking off to the closing bell here in the U.S., and it is risk-off across financial markets today as Israel prepares for a ground invasion of Gaza following the surprise attack by Hamas last weekend. We do see a flight to safety taking place, putting a bid under treasuries. You see the 10-year yield coming down to 4.63%, pushing yields overall lower. For the week, yields are set to fall for the first time since September 1st. Now, gold climbed above $1,900 an ounce. It's currently up by more than 3% after breaking through its 50-day moving average a little bit earlier. And we cap off a volatile week for oil, with WTI ending the week the way it started, with big gains, currently up by more than 5%, approaching $88 a barrel. And when you look at equities, it's pretty much a mixed to lower picture for the major indexes. Losses in big tech stocks more than offsetting the gains in banks as well as energy names. Romaine?
Yeah, certainly a weird week, a volatile week, a weird mix of unease about central bank policy, fears, of course, about the escalating conflict in the Middle East, and trepidation about corporate earnings. That confluence sent investors into haven assets this week in a big way. The Swiss franc at its highest level of the year versus the euro. The dollar up for a fourth week against a broad basket of peers. And you just mentioned gold. Prices just on this day alone surging the most since March, Scarlet. And then, of course, there's treasuries. Benchmark 10-year yields that went on a roller coaster ride, pulled down by that haven buyers looking for some sort of safety, and then pushed higher by sloppy auctions and hotter than expected inflation data. I think a lot of people would like this week to sort of come and go, but it doesn't necessarily mean what's ahead is going to be any better. The impact on treasury prices not just coming from investors, but also from the feed through on deteriorating consumer sentiment. Survey data out from the University of Michigan showing consumers' feelings about current and future economic conditions, they're down. A big part of the reason, consumer expectations for inflation, they're up. They appear to have come unanchored and are drifting higher. Former St. Louis Fed President Jim Bullard saying investors may have to recalibrate as well. Speaking on the sidelines of the IMF meetings in Morocco, Bullard said the market is underpricing the risk that disinflation stalls and core PCE starts to go up again. Some glint of that scenario may be revealed, or I don't know, maybe debunked, Scarlet, by the Q3 corporate earnings and the forecast, which started to roll in this week with the three of the biggest banks, I should say, here in the U.S. actually providing somewhat of an upside surprise.
Yeah, but perhaps expectations were low heading into that, right? Net interest income is the one that we're looking at here. The overall takeaway for the big banks so far, better than expected results. These are the sell-side estimates for the four biggest banks as net interest income as we headed into third quarter earnings. And you can see the combined NII over here has pretty much plateaued, with banks paying out more to depositors as they compete for business. JP Morgan, that's the light blue bars section of the bars. It's a bit of an outlier because it added First Republic's customers to its fold after the regional banking stress earlier this year. Now, in terms of stock performance, there is not much love for the banks. What these bars show is the spread between the KBW Bank Index and the S&P 500. And in 2023, it's a 37% difference. That is the most ever. The KBW has tumbled about 24% this year. The S&P 500 is up about 12%. So in addition to higher funding costs, Romaine, banks are contending with unrealized losses in their securities portfolio because of those rising yields and increased bad loan write-offs. And of course, we can't forget there's increased regulation like higher capital requirements looming on the horizon as well.
All right, a lot for investors to parse. Let's see if we can get some insight out of our next guest. Ellen Hazen joining us right now, Chief Market Strategist and Portfolio Manager at F.L.Putnam Investment Management, helping us kick us off to the close here on this Friday afternoon. And you heard Scarlett going through some of the earnings that we got out of the banks this morning. And the banks obviously give us a read on the financial sector, but more importantly, they kind of give us somewhat of a contour of, I guess, economic conditions, Ellen. And as we head into this earnings season and we start to hear from other companies, from other industries here, do you think that the worst case scenario that everybody seemed to think that might actually now be baked into what happened in the Q3 and we're past that now in Q4?
Well, certainly if you look at the U.S. consumer, they are showing signs of weakness. Now, is that fully reflected in the stock market? Difficult to say. I would say that we're seeing decent responses today out of the bank stocks after what were pretty good numbers today. JP Morgan is up, as you saw. But I would point to what Jane Fraser said on the Citigroup call. where she pointed out that consumers are weakening and that consumers have drawn down their excess savings. So I think that the banks are pricing in a lot of bad news already. So in that sense, we probably have seen the worst. And I don't think it was as bad as folks thought back in March when we saw the string of bank failures. But I do think that that will be a headwind for the banks going forward. The places where you saw strength were primarily in sales and trading, and with lower than expected delinquencies, lower than expected charge-offs. But that can't sustain forever if you're seeing the consumer weaken.
And it's interesting, too, some of the commentary that we've heard from the bank executives this morning, Ellen, they seem to have some, I guess, trepidation, but they also seem to reinforce this idea that in their view, the economy still overall is strong, despite the fact that we know there are a lot of black swans sort of circling right now. But at least the fundamentals themselves, in their view, seems to be solid.
I think that's right. And loan growth wasn't too bad. And as we look at the various parts of the bank's income statement, the weak areas are known, right? You had Wells Fargo talk about the weakness in the office part of the commercial real estate market. So that's a known, and people know that that's going to happen. But just like you see with the PMIs, the services PMI has been fine this whole time while the manufacturing has been poor. If you look at manufacturing, it's beginning to improve. Similarly, if you look at the components of GDP in the most recent quarter, you see increased spending by corporates. And so there are signs that corporations are picking up the spending where consumers might be dropping off a little bit as they've used up some of this excess savings from the COVID era.
So that's a really interesting observation. Do you see that as a clean handoff from consumer spending to corporate spending without too much of a hiccup in the overall economy?
Well, I think a smooth handoff in an economy as large and varied as ours is always a difficult thing to predict. But you are seeing the consumer slow and you are seeing corporate spending pick up. And part of that is being driven by very sustainable causes. In other words, the various federal programs that got put into place between the CHIPS Act and the Inflation Reduction Act and the infrastructure program. There's a lot of spend that's going into corporate spending. And so I do think that there are underlying reasons why the handoff could be smooth. But to forecast that it will be, no, I don't think so. I think there will be some hiccups. But if you can look through that, the underlying fundamental reason is fairly sound.
Okay, you make the case for why corporate spending might be picking up. If we do see consumer spending weakening, how does that affect your allocation? Where do you want to be? Where do you not want to be?
So we're looking at increasing areas that are a little bit less sensitive to the consumer. We're looking at increasing industrials, and we're looking at increasing healthcare. So there are some areas of the consumer that are fine. But as we saw from the airlines recently, parts of the consumer are weakening. And, that makes sense. They had a goods-fueled spending binge during COVID, and they had a services-fueled spending binge in the most recent year or so. And that's going to fall off a little bit. So I would rotate out of some of those consumer names into things that are more levered to corporate spending.
What gives you, I guess, a little bit of confidence about the industrial space, Ellen? Because when I hear that, I guess it kind of makes sense. But then I worry if we're talking about maybe the potential for economic conditions to soften here, aren't a lot of those names going to be tied to that cyclicality?
The question is whether or not we have a hard landing, a soft landing, or an elongated cycle. If we have a hard landing, then I agree with you. Corporations and industrials will be negatively impacted. But so far, the data is not pointing that way. We've all seen the strength of the labor market. We've all seen the strength of the services sector. And so absent a hard landing, I think the industrial sector can be okay. And certainly, as I said, we have a lot of fiscal spending backing it up.
I know you're a long-term manager, but I do wonder, Ellen, if you are concerned about some of the volatility we've seen, particularly in the asset classes that typically don't see that type of volatility, like the Treasury market.
Well, the Treasury market has had 15 years of very unusually low interest rate suppression, some call it. And we're exiting that phase now. And if the Fed holds the course, which certainly it seems at the moment that that's what they're signaling that they'll do, then the whole economy is going to have to go through an adjustment phase to a structurally higher cost of capital with, oh my goodness, positive real interest rates, which wasn't true for a long time. So yeah, some things will break when that happens. And you do see that with the Treasury market in conjunction with some of the the way that the Treasury had run down their account and they need to build it back up and so forth. So there are some mechanical reasons as well. But ultimately, I think what we're seeing is a reversal of this 40-year secular reduction in long-term interest rates to very, very low, I would argue unnaturally low levels. We're seeing that go back to something like normal, and it will be a little bit disruptive, but I don't think that it is the sign of impending devastation.
All right, a wealth of experience, and always great to get your insights out of you, Ellen. Have a great weekend. Ellen Hazen there, Chief Market Strategist over at F.L.Putnam Investment Management, helping us kick us off to the close here on a Friday afternoon where we got a slew of bank earnings this morning, including Wells Fargo. A conversation coming up with the CFO, Mike Santomassimo, on the heels of that earnings beat.
Plus, central bankers and finance ministers, they're gathering in Morocco for the IMF and World Bank annual meetings. ECB President Christine Lagarde shares her thinking on what's next in the bank's fight against inflation.
And we're going to check in on the tech space with veteran Wedbush analyst Dan Ives. He'll be joining us primarily to talk about what he's been seeing with data analytics giant Palantir, as well as some of its peers. That conversation and so much more. Stick with us. This is Bloomberg. All right, big bank earnings kicking off this morning. We heard from Citigroup, we heard from J.P. Morgan, and we heard from Wells Fargo. And so far, well, so good. A firm beat of analyst expectations here. Net interest income topping expectations, and the full year guidance getting nudged higher. Pleased to say that the Chief Financial Officer of Wells Fargo is joining us right now, Mike Santomassimo. Mike, great to have you back here on the program here. Let's start off here with the net interest income here. I think overall, most investors were pretty pleased with that number. What actually led to that beat?
Yeah, no, we were pleased with the quarter overall, and I think what you saw in the results was just the benefit we're getting from higher rates. And as we looked at the earlier in the year, we were sort of trying to get a sense of how deposits were going to move, what kind of mix shift we were going to see, and what pricing was going to look like. And as we get better clarity throughout the year, we were able to realize more of those benefits than we thought at the beginning of the year, and that helped us to increase our guidance for the year up 16% versus the 14% we talked about in July. And I think you see that come through in the results there, net interest income.
Well, given the trajectory of benchmark rates, and more importantly, some of the volatility in that path, when does this higher rate environment, if at all, and the balance that you, of course, have to have with your consumers, when does that start to work against you?
Well, I think you got to think of it in a little broader sense, right? I think, the economy is definitely slowing as a result of rates coming up, and so that's having an impact on consumers. We're still seeing it be much more resilient than we would have expected at this point, but we're seeing, good activity levels, but cash balances are coming down. And as the longer rates stay higher, our deposit costs will continue to increase like you've seen over the last, couple quarters. Having said that, I think when you look at the overall mix of our business, we're very much weighted more towards the consumer side. Those are accounts generally, the majority of them at least, generally have, smaller dollar amounts in them. And so you see a little bit less pressure from a pricing perspective there so far.
Less pressure from a pricing perspective. What is your base case scenario, Mike, for the cost of deposits? Has the process for raising the rates that you pay depositors mostly run its course? I mean, are you, 70% of the way through, you think? 80%?
Yeah, it's really hard to know. I think that it'll be a function of where rates go from here, whether they go up further, whether they stay flat for a longer period of time, and so I think it'll really be that. But really where we're focused is making sure that we continue to do more with customers too, right? So you see that come through our credit card results, where we've got really good originations and growth in credit card spend. And you see that, you're hopefully starting to see that in our wealth management business. And so I think hopefully over time we'll do more and more with customers to kind of round out the relationships there.
Right, gotcha. I got to ask you about bank capital rules, because that's something that so many of the bank leaders have warned about and have talked about. It hasn't happened yet, but I wonder what actions you'll have to take as preparation for this to happen. What steps have you taken so far?
Yeah, well, first, I think we come into this in, this rulemaking and environment in a really strong position. Our capital levels are high, and we're already at the level we need to be if the rules were implemented as written, today. Mm-hmm. So we come in with a lot of flexibility, which is good. Now, it's a complicated set of rules. It's going to take the better part of a year to finalize. And so, and we're going to, go, rule by rule or section by section to make sure that we're doing the right things there. But it's a little early to start taking too many actions right now. But we do need to be cognizant of like some of the places that are going to be a little more challenged as a result from a return perspective. But it's going to take some time to really play out, and we look forward to continuing to engage with the regulators through the comment period, and we're hopeful there'll be some changes made, but we're prepared to, deal with whatever comes as when the rules get finalized.
Well, and I'm sure, as you know, Mike, this still kind of almost seems to be a rolling issue right now because we still haven't quite figured out exactly what happened with the regional banks earlier this spring, and there's a lot of concerns about the commercial property market going forward. All things that I think would weigh into the decision as to just how much to impose upon the banks by regulators.
Well, I think you have to, take a little bit of a bigger, picture here. And look, the banks are in really good shape and overall. And I think when you look at, Wells Fargo in particular, I think we're in great shape. We have strong capital. We have strong liquidity levels. We have, good coverage against credit losses that are there. We have a smaller markets-oriented business than many of the other big banks. So we're maybe in a little bit of a different, position. And so I think you have to let it sort of play out. And I think, when you think about the capital levels that have increased in the industry over a very long period of time, it's been a lot. And so, how much more do you need to do from here, I think, is an open question. And we look forward to, engaging with them on that.
I am curious about some of the strategy changes that have taken place under Charlie Scharf, and I'm sure Jamie Dimon even gave a hat tip to his former protege a little bit earlier on his conference call. When you consider some of the moves that have certainly reshaped not only the revenue sources, or at least the percentage of revenue that you're getting from certain sources here, what becomes longer term the way you plan out to protect those businesses, or at least to set them up in a way where that revenue stream is sustainable longer term?
Yeah, well, it starts with having a really clear strategy of who we want to serve, and I think that's what we've been trying to focus on, and I know Charlie's been focusing on since he came to Wells. And I think you've seen us take a lot of action to sort of, orient the businesses to what we think the strategies are. And then it just takes, very methodical, disciplined investment in those businesses over a very long period of time. And I think you're starting to see some of the benefits of what we've done over the last few years, including our credit card business. We're seeing some benefits in our wealth business. We've been investing in our investment banking business as well by adding people, particularly in the last, year and a half or so. And so I think you'll start to see those benefits come through, and that's the way you sort of set yourself up for success over a long period of time, is make sure you got the right capabilities, the right products, the right people, and you do that in a very disciplined way while we continue to fix all of the risk and regulatory work that we've got to get done. And I think that's what you'll see and what will set us up for success over time.
It's a long to-do list, Mike. Good luck to you. Mike Santomassimo is the CFO of Wells Fargo Bank. We're going to stick with the big banks and turn to Citi now, which also reported results this morning. The firm going through a major overhaul. It trimmed headcount by another 2,000 jobs in the third quarter, bringing total severance charges for the year to $650 million. Bloomberg's Jenny Serrain, who broke the news, has more with us now. And how much of this is tied to Jane Fraser's overall restructuring efforts?
Yeah, so the 2,000 jobs that you just outlined are actually completely separate. So that's some of the work that they're doing kind of heading into the overhaul to, slim down and make sure that they're acting in as simple of a way as possible. But this broader overhaul and kind of the changes that Jane laid out last month, CEO Jane Fraser, that's actually all to come. So you're just seeing Citigroup take a lot of really big swings here. You really see Jane trying to kind of get her ship in order. She laid out the strategy at Investor Day over a year ago now, and you really just see her starting to make the organizational changes that's necessary to make sure sure that the bank is kind of firing on all cylinders and really aligned with that strategy that she laid out last year.
What is the bigger plan? I understand the organizational changes maybe sort of grease the wheels here, but has she articulated sort of what the end game is?
Yeah, I mean, I think her big thing is that her returns need to get in line with peers. And so she's found, at least in her mind, these 5 businesses that she thinks will really get them there. So that's wealth management, trading, the U.S. consumer offerings, her services business, that's what she likes to call the crown jewel of Citi. So that's like treasury management, security services, and then banking. So good old-fashioned investment banking.
Yeah. And as part of that, it's also divesting a lot of the retail branches in overseas markets. Any progress on that front?
Yeah, so that was last year again, or I guess 2 years ago now. They announced that they're going to get out of over a dozen retail units overseas. They're pretty close, actually. So they're in the final stages of the sales, and then they've had to wind down a couple, like Russia, China, Korea, and so they're about 2/3 of the way through that work. Mexico is the kind of big outstanding one there. So that sale process was thwarted by President AMLO earlier this year, and so they're now going to IPO that business probably in 2025. So in various stages, it's a long road to go. I mean, she's got a lot more work to do on this front.
A lot of talk about, I guess, the jobs she's cutting and some of the fat that she's trimming here, but where is she adding resources?
Yeah, so it's interesting because they, like we talked about, they've cut 2,000 jobs just in this quarter alone, but headcount was flat. So even as they're cutting all these jobs, they're still adding a ton of headcount. And really what they've said on that is it's technology workers, as you might imagine, but they're also still under these consent orders from 3 years ago that they got from the OCC and the Fed. And so they've needed to hire a lot of folks to come in and kind of do that transformation work.
Compliance.
Yes.
Do Citigroup employees get free Citi bikes here in New York?
I think they do have some sort of deal for them. Yeah,
I've always wondered. I mean, it seems
they get
logical.
a discount if I remember.
A discount. Yeah, exactly. I think it's but now that it's owned by Lyft, it might be different.
I mean, if you want to, if you want to hire the creme of the creme, free bike rides every day.
Yeah,
I'd sign up.
It's a nice thing.
All
discounts. Jenny Serrane, thank you so much. Bloomberg's Jenny Serrane covers the banks here in the U.S. and soon we'll be off to London to cover European banks. We've got much more ahead. This is The Close on Bloomberg.
All right, the end of an era is upon us. The way we consume media has been changing for quite a while, but now we're really starting to see it accelerate, at least for some of us of a certain age. DVDs, Scarlet Fu, are going to be no more on the shelves at Best Buy. You remember, of course, last month, back in September, Netflix basically delivered its final DVD ever.
Much to Abigail Doolittle's dismay.
Yeah, and now Best Buy is saying that after this year, no DVDs on its shelves anymore.
You know where they're still going to have DVDs? The library. The public library will always have DVDs available to
Are you one of those people? Do you go to the library and watch
I do go to the
videos?
library a lot, but I don't borrow DVDs. But that's because I have several Case Logic binders of DVDs I don't know what to do with.
Case Logic binders.
Yeah, remember those?
Scarlet Fu. I thought you were younger than me.
It's in a closet somewhere, hiding. I think Being John Malkovich is in there,
Being John Malkovich?
Yeah. Come on, Gen X, Romaine.
Scarlet Fu and our DVD collection. That conversation coming up after the break. Stick with us. This is Bloomberg. We continue to see that sell-off in stocks. We continue to see a rally in bonds, and there's a big bid coming in right now in the oil space. Abigail Doolittle standing by right now with a closer look at the commodity space with our Commodities Close.
There certainly is. We have a lot of strength for commodities, and I will say first, if there was a commodity for DVDs, it would be up 100% because I will now be out there buying tons of DVDs. But in all seriousness, take a look at commodities. This space up nearly about 2% overall. Oil really the big gainer here, up 5.8%, the best day going back to March. And of course, there is a war premium, fears that supplies could become a little bit more scarce around the Middle East conflict. Same deal for natural gas, for European natural gas, I should say. Over the last 5 to 6 days, up about more than 30%. One oil field was closed down. An offshore oil field was closed down off the coast of Israel, Chevron's field. So there is a premium there as well. And then take a look at the precious metals soaring. Gold up the most since April. Silver up the most since July. all of this as the Bloomberg Dollar Index is up for a second day in a row. So we're going into this weekend with these fears, these geopolitical fears. And if we take a quick look at the oil chart, what could be next? Well, it's interesting because there's been so much volatility for oil. We, of course, had this massive rally higher and then the move down. But you can see that there's basically an uptrend holding. Oil now, Romaine, is back above the 50-day moving average. This appears to be a bottoming pattern. This chart may suggest that we're going to see oil go back toward its recent highs, maybe even higher.
All right, a great wrap up there by Abigail Doolittle here. We want to stick here in the geopolitical world right now and some of that instability that Abigail was referring to. That's dominating the conversations at the IMF World Bank meetings in Morocco. Christine Lagarde, the head of the ECB, sat down with Tom Keene a little bit earlier to talk about the challenges facing central bank policymakers.
There are multiple previous shocks, from the disruption to the supply bottlenecks, to the immense volatility of energy prices, to the pent-up demand against the restricted supply, and all of that happening in a very abrupt and sudden way. So that's number one. Number two, something which is affected by lag time, or time lag, whatever you call it. And I'm not here talking about monetary policy. I'm here talking about the adjustment of wages to inflation. And there is clearly in everybody, in all central bankers' mind, the fear of the second round effect. Is it happening? Is it likely to happen? Are we at the peak, and are we now going to see declining wage increases returning to real wage a la pre-COVID? Question mark. That's another moving part. The third moving part is what I would call the strong. You know, we did 450 basis points hike in 15 months, which is a huge, unprecedented increase. And this is what I call the strong but lagged policies. We haven't seen the end of it yet. We're seeing tightening of financing conditions like it has never happened before. We know that there is some more in the pipeline, and how it is going to impact our economies, how it will have deflationary impact, disinflationary impact in our region is also to be seen. And the final one, you know, sort of really ball in the air, is the structural reforms that will come out of all that. There is what, Ngozi, you called the, did you say re-globalization? Mm-hmm. I would call it probably consistent with a good fight against climate change, the near-shoring, not reshoring, not French-shoring, but reducing the distance, having a better handle and control over your supply chain and the logistic and transportation. That's just one example. I think the labor market is also a case in point where we will be seeing structural reforms, and where the people who are joining the market now have different aspirations, different expectations than what we had, but, you know, let alone the two grandmothers at the table here. All of you, the Z generation, will not want the same thing. So those are all these balls in the air. We're not exactly sure how they're going to land, but certainly we all have to focus on our policies as far as the European Central Bank is concerned. As I've said before, right. Our mission is to return inflation to 2% medium term, and we will. And it is happening as we speak, and we will hang on to that, be steady, long enough, and ready to do more if necessary.
And the head of the European Central Bank, Christine Lagarde, speaking a little bit earlier with Tom Keene out in Morocco, where the IMF and World Bank actually holding for the first time their semi-annual meetings on the continent of Africa here. Interesting to hear some of the commentary by Lagarde, as well as some of the other policymakers. And they do all seem to be singing from the same hymnal. Yeah. They may not have the same policy, but they all seem to kind of be on the same page when it comes to that sort of confluence of economic conditions.
Absolutely. And of course, the conflict in the Middle East just raises their concerns even more. I mean, you think about Europe in particular, they have to deal with rising natural gas prices. Already, Ukraine was a big concern. Now you've got the Middle East to add to that. Once upon a time, you just looked at weather patterns and whether it was going to be a brutal winter. It's a real calculus that policymakers have to consider here.
It'll be interesting, too. I mean, there was obviously a little bit of a visceral reaction in the currency market, I should say, in the bond market, for that matter, over in Europe, to some of the guidance, or I guess the perceived guidance that she might have communicated here. I think people want to see her maybe shift policy in a way, I guess, that's at least the market. They always want it to shift, right? Do what's favorable for the markets is what they want. At least for right now, I think she's trying trying to do what's favorable in her mind for the economy.
Yes, and for tackling inflation, which is their only mandate, really. All right, still ahead, we've got cybersecurity and geopolitics, how those two intersect. We're going to discuss how cloud software companies like Palantir could increase demand for their services in times of global conflict. This is The Close on Bloomberg.
From the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Oshkosh, the maker of military vehicles and fire engines, upgraded to buy over at Citi, with the analysts calling it an outlier on earnings momentum within the machinery sector. He also sees a lot of margin upside in that new vocational segment that the company just formed, which actually includes those fire trucks. Shares had been up almost 2% on the day, but gave that back and then some. Next up, let's take a look at Netflix. Cut to peer perform over at Wolfe Research. The analyst there says average revenue per user expectations for next year may appear to look, quote, full, but could actually lead to shortfalls in gross additions. Shares of Netflix down about 2% on the day. And finally, a wild story right now involving JD.com. Several firms on Wall Street either downgrading the company or cutting the price target in the past 2 days alone. That includes an equal weight cut over at Morgan Stanley this morning. This is on the back of reports about the arrest of a man in China with the same last name as the chairman of JD.com. Now, this has not been confirmed here, but investors are speculating, and analysts on the street aren't waiting to actually pull the trigger here. JD.com, which fell 8% yesterday, down another 3% here today. And those are some of our top calls. All right, we do want to stay in the tech space here and fold it into some of the current geopolitical events going on right now. The unrest between Israel and Hamas could drive global spending on cybersecurity and analytics. Cloud security providers such as CrowdStrike, Zscaler, and Palantir may be able to upsell both government and private entities for their services. Dan Ives has been covering this sector and knows it better than anyone. Senior equity analyst over at Wedbush joins us right now. And Dan, let's start off here with, I guess, the potential opportunity. We know there's been a big push by corporations and governments, for that matter, to beef up their cybersecurity defenses, if you will, here. How much do you think the current conflict unfolding right now in the Middle East could accelerate that?
Look, I mean, the tragic events that we've seen, I think it's one from a cybersecurity perspective. This is not just from a government perspective that we're seeing just in the U.S. or in Israel, but I think what we're seeing across enterprises is you are seeing cybersecurity spend that's going to be up 20% next year, regardless of what we saw this year. And I think that's important because this is becoming, from a high priority perspective, names like CrowdStrike, Zscaler, Palo Alto, Checkpoint, again, with a lot of them actually based either in Israel, a huge R&D. I mean, this is actually a golden age for cybersecurity. And I think what you're seeing more and more is how important it is becoming even in the geopolitical landscape.
I'm curious about, when we talk about these cybersecurity companies, it seems at times that it is somewhat diverse or dispersed, I guess is the word I'm looking for here. And I'm wondering if we do end up seeing some degree of consolidation among some of these players.
Yeah, look, I think we are going to see a surge, a tidal wave of M&A.
Yeah.
And I think this is really get out the popcorn moment for that. I mean, we've started to see some M&A in terms of Cisco, Splunk.
Yeah.
I think that's just the start, because this is really going to be a golden age for cybersecurity. And when you look what's happened with AI, we believe this is actually going into a 3Q earnings season where tech stocks rip higher, despite what clearly is a nerve-wracking environment and a lot of agita up there. And I think that's really going to be the theme here. Cloud, cybersecurity, big tech leads us higher.
So when we talk about M&A, I'm fascinated by that. Are we thinking more companies like Cisco, old tech companies, buying some of these players, or consolidation between the little players themselves?
Well, I think you're going to have the strategics. You look at what I believe like Oracle. I think Microsoft could do more deals. I think Adobe and some others. And look what happened with Microsoft Activision. I mean, that was a black eye for Khan and the FTC. That's really showing big tech flexing muscles. They're not worried too much about the 202 area code. So you're going to see the strategic deals, and then I think financial. I think financial, you look at PE and M&A. I mean, this is going to be it's a get out the popcorn moment. I believe we are going to see M&A massively spike over the next 3 to 6 months.
All right, get out the popcorn moment is certainly one way to think about it. I want to focus in on Palantir in particular, because with the conflict in the Middle East, you say that Palantir will be a key partner of Israel. We already know Palantir is a key partner of the U.S. government as well. Is it limited in any way in terms of how many governments it can partner with?
Well, it's not. I mean, look, let's take a step back. As a pure play AI name, it's probably the best software out there from core AI, what Karp and Palantir have done. When it comes to defense, that's clearly their strength, right? So they will be the eyes and ears, especially for Israel, IDF. We've seen that in the U.S. as well. I mean, Palantir, you talk about defense budgets and where this is all going, strategically the top of the list. And I think it just shows more and more, even as they've gone into enterprises. Palantir, I still believe, is a very underappreciated story by investors that really don't understand what could really be the full, what I believe, AI story playing out here.
I am curious about that, too, because I understand that there's a certain black box with this company that is kind of a necessity, given some of what they do here. But I also feel that we don't necessarily hear enough sometimes from the executives there. We don't see them as much here. Does that matter to you?
Yeah, look, I think there's no doubt. I think by nature of what they do, there's a lot of stuff that they can talk about. I do believe they have started, we were at a customer conference, a month or two ago. I mean, they've started to be a little, from an investor perspective, a little more open. But I think that's going to be part of the story. I mean, if you look at Karp and Palantir building, and we've called it, what I view as probably one of the gems in AI, and I think it's just starting here. Defense was actually their roots. Enterprise and going forward, that's really going to be a lot of the core growth. We believe this is really going to be an AI revolution with Palantir playing a major role.
All right, it's at the leading edge there, certainly. Dan Ives, really appreciate you joining us, coming in here on a Friday. Dan Ives of Wedbush. Now, all out for Palestine protests are taking place globally, and we see in New York City, they've boosted their security. You can see right now, live shot, this is lower Manhattan, Midtown Manhattan, outside Baruch College in about 25th Street and Lexington. We're going to dive into how the city has prepared for these protests. That's next. This is The Close on Bloomberg. Today's Bloomberg Big Take is focused on the conflict between Israel and Hamas and its potential to disrupt the world economy and perhaps even tip it into recession if more countries are drawn in. Bloomberg Economics chief economist Tom Orlik is here now to discuss. And Tom, a lot of this revolves around what the scenario looks like, whether this is a confined war, a proxy war, or a direct war. In the best case scenario, a confined war, I guess if you can put it best in quote marks. What are we thinking in terms of the impact on the global economy?
So primarily, of course, Scarlett, the events unfolding now in the Middle East are a human tragedy, and I think that's top of mind for everybody. Our piece takes on the potential economic impact, and we think through a number of scenarios. Now, if we start with the confined war scenario, that's where we are today. That's Israeli forces leveling Gaza. Potentially, it's skirmishes between Israeli forces and Hezbollah, but it doesn't blow up into a broader regional conflagration. If that happens, probably you see oil prices a little bit higher. Indeed, we've seen oil prices move a little bit higher since the beginning of the conflict, but the impact on the global economy is pretty limited.
There's obviously a lot of concerns here about this broadening out into, I guess, an old-fashioned, full-scale head-to-head war. There's also a lot of concerns, Tom, I'm sure you know, about sort of another sort of layer of the proxy wars that we've seen in the Middle East over the past few decades.
I think that's completely right, Romaine. And of course, we've seen U.S. Treasury Secretary Janet Yellen speaking today and talking about how important it is that this doesn't blow up into a broader regional conflict. Now, in our big take, we also consider that unwished for scenario. And we think about what might happen if this isn't just Israel and Hamas. It's not just Israel and Iranian proxies in Lebanon and Syria, but it blows up into a direct confrontation between Israel and Iran. And if that happens, the scenario we construct, based on what's happened in past wars in the region, is for really a very, very sharp rise in oil prices. If oil prices go from all the way where they are now to $150 a barrel, our models tell us that would take a full percentage point off global growth. That would take global growth for 2024 all the way down to 1.7%, the lowest level since the early 1980s. So that's a risk scenario, maybe even a low probability risk scenario. It's not where we are today, but as tensions continue to rise, as emotions run extremely high, it's a possibility that we need to start thinking about.
Yeah, and I know you don't get into this in the big take story, but having been someone who's covered China and looked at Asia, there's a lot of questions as well whether other countries might take advantage of this moment of conflict to perhaps pursue their own aims, China, Taiwan, for instance. How are you starting to think through some of that? Because that always comes up every time there's any kind of conflict where a country invades another.
Yeah, I mean, certainly, if we think about the geopolitical risks, which have the capacity to significantly move the dial on global growth, then Taiwan would come near the top of that list.
Yeah.
And we have an election in Taiwan in January. Which potentially is a moment where we could see tensions increasing. I think if you speak to the kind of China strategists and the Taiwan strategists, though, what they would tell you is actually the status quo in the Taiwan Strait, the uneasy stability, it's pretty sticky and not likely to change anytime soon.
All right, Tom Orlick, there are chief economist over at Bloomberg Economics with the global view of those geopolitical conflicts now unfolding. And back here at home, near our Bloomberg World headquarters, protests are now taking place here in the streets in support of Palestine. Joining us right now is Bloomberg New York Bureau Chief Katya Borzikansky to talk a little bit more about this. And I think a lot of folks in the city were on edge when word got out that these protests were being organized. What do we know about the organizers?
We know that they're a variety of different groups, and they're coming together across various protests. I mean, they're all over the city. We had a reporter who attended the ones at Columbia University yesterday. There's one large one that's going to take place imminently in Times Square with a host of different groups attached to the flyer. Hard to know if they're actually affiliated with it. And then we have also on CUNY campuses, they're popping up all over.
And I think that's what we're looking at right here, which is Baruch College in Manhattan. What is Mayor Eric Adams saying about the city's preparation for all of this?
So the mayor and the NYPD keep stressing that there are no credible imminent threats. And while a lot of people are on edge to go about your daily life, that you're going to be protected, that you're going to be fine, they've boosted security at synagogues, at mosques, at schools, throughout the transit system, and you can just generally see an elevated police presence around the city. Several friends have texted and said, they're boosting security guards at my kid's preschool or wherever, even places that aren't religious institutions.
So do we have a sense here that some of these stepped-up security measures are going to be here to stay for a while until whatever is going on in the Middle East is resolved?
That's a good question. I mean, given that there's probably no imminent solution to what's happening, there'll probably be responses to just with the societal unrest, right? Like this was known to be the day of rage, and so there's been anxiety in the Jewish community for the last several days. Social media has been aflutter with paranoia about what would happen today. And so I think there's a response to that. Mayor Eric Adams is very close to the Jewish community here in New York City. So there is a direct response to that constituency.
And we've seen this a lot in New York City, where we have some incident overseas, and then of course they have to step up the protection of synagogues and other places of worship in order to make sure that people feel comfortable.
Of course, it's nothing new. They also do it during the high holy days.
All right, Katya Porzakansi, thank you so much. New York's bureau chief here for Bloomberg News. And Romaine, a lot of people didn't make it into the office today because of these protests. I mean, it was pretty empty at the garage when I parked my car this morning.
Yeah, it was hard to kind of know what to make of this, right? I mean, it's one thing to say, okay, we're going to come out and protest, but I guess as long as it's peaceful. But I think it scared a lot of people away, not just because of those protesters, but I think there was this fear that you're going to have counter protesters, and then that could cause some issues. At least for right now, we don't have any reports of any significant incidents there. We will keep an eye on that here as we march to the closing bells here. We're about to round out into the final trading hour of trading here on this Friday afternoon for the week. Another wild week that has stocks on the back foot on the day, though. Some of the indices still clinging to weekly gains, believe it or not, Scarlett.
Yeah, but that's a lot of red on the screen right now, really highlighting the risk-off sense as people are really on edge with concern about what's going to happen next in this Middle East conflict.
A flight that you see there into treasuries here on this Friday afternoon, a flight into the Swiss franc, seeing similar flights into gold as well. Stick with us. Romaine Bostick and Scarlet Fu. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Romaine Bostick here.
And I'm Scarlet Fu.
Interesting day here in the market, Scarlett. Kind of a little bit of a rinse, repeat. But this is a market right now that has really kind of been left to its own devices. We talk about whether they're focused on macro conditions, whether they're focused on the war in the Middle East, or whether they're just trying to figure out whether companies are actually going to finally sort of call that earnings trough and we're going to start to see something better in the fourth quarter.
Well, there are a lot of expectations and hopes that maybe the earnings recession ends for the third quarter numbers, but it's still early days. And we did get numbers out of the banks that suggest that things are looking better, or at least they're not looking worse. But it's really interesting that on a day like today, you have banks outperforming and big tech down. What happened to big tech being a safe haven?
I think I think people are going to the traditional havens. At least we've seen that over the last couple of days. Remember, a lot of those haven bids that we had seen before seem to be driven less by those geopolitical issues and more by macroeconomic conditions. And I think this time, when you get the rubber hits the road, when you are talking about war and the potential for a spread of that conflict here, what do you go to? You go to the franc, you go to the yen, you go to treasuries, you go to the dollar.
You go to gold.
And gold, yeah, good point there. And you see that. Gold actually having one of its best days in about 6 months now. WTI crude having one of its best days in quite some time here, not necessarily for the right reasons. And if you flip up the board real quick, too, I mean, we have to talk about the volatility and pretty much the volatility in the Treasury market. You know, I'm going to just borrow a line from John Farrell that said, you know, the Treasury market is trading like a penny stock some days, it looks like. And we talk about, what was it, a couple days ago, we had that big surge in yields, and then we had the big drop in yields back down. And I mean, gosh only knows what we're going to see on Monday. And you see, and just for our viewers, that white line, that's the move index there. And the blue line, that's the VIX. And that's the disconnect here, because normally you would expect that VIX to really perk up, or at least some of the equity measures of volatility to pick up. But no, it's the white line.
Yeah, it's really interesting how equity volatility is really tamped down, while something like TLT, which is the ETF that tracks longer dated maturities bonds, have been making 2% plus moves 3 times this week already. You don't normally see that.
I wonder if this drives a lot of people to the sidelines as well, because you can say, oh, a lot of money was made, and a lot of money was made in, what was it, oil stocks this week, XOP having a great week, obviously defense stocks. But you also get a sense here that if the situation in the Middle East does tamp down and we find a somewhat reasonable solution to it, then does that trade get unwound pretty fast? Yeah,
perhaps, although I don't know that anyone's looking for a near-term solution to what's happening in the Middle East. Let's take a look at some of the outperformers on the day, the big banks, because you had JP Morgan, Wells Fargo, and Citigroup reporting. Citigroup actually just turned lower.
Citigroup can never catch a break on its earnings day.
Well, you know, and maybe that's why it's making some big moves, cutting jobs and restructuring everything, and really looking at its expenses with a closer eye. But overall, better than expected numbers lifting those banks. I wonder to what extent banks are really a read on the overall economy as opposed to just a read on monetary policy.
I know there are a lot of people that sort of doubt doubt, I guess, just how much of a read they give. I'm actually a believer because I do think, particularly with the banks that have large consumer operations, so like a Wells Fargo, Bank of America, even Citi to a certain extent, you do get more of the contours, I guess, of what the shape of the economy is.
Demand
right
looks like.
Yeah, because you can see, loan loss reserves and delinquencies and mortgage activity, and so
credit cards.
You get some sense.
Yeah. All right. Well, let's take a look at what's going on in Boeing because it is the biggest decliner in the Dow Industrials. I know.
Close your eyes, folks.
Yeah, it's not a pretty chart. Look at that. It is off by more than 3% right now. Signs of worsening 737 MAX aircraft production issues. It continues to dog this defense company, which, by and large, most defense stocks have been doing fairly well in the last couple of days.
Yeah, but this is just such an idiosyncratic story right now with Boeing and just dealing with some of the supply chain issues. Spirit Aerosystems, also down a hard here on the day.
All right, and Dollar General, we're seeing a relief rally in this beleaguered dollar store chain. The CEO, Jeff Owen, has stepped down. He was at the helm for almost 1 year, and I was looking, the stock plunged about 60% during his tenure. There are also a lot of workplace safety concerns that have been published, and Bloomberg Business Week did a deep dive into what's been going on at Dollar General.
There's been a lot of great stories here about just their labor practices and the way they run their stores. And I'm glad you brought up the stock thing because I think investors, they focus on those anecdotal stories about what's going on in stores. But you have to forget, when you talk about return to investors, it just hasn't been there.
Well, the former CEO has come back. It's kind of like a Bob Iger situation over at Dollar General.
Don't say that. Bob isn't doing too well.
Well, how about initially when Bob Iger
You know what could help Bob Iger? Bring back DVDs. How about that? I think Abigail Doolittle, I think, could provide at least a couple of percentage points of margin boost for that name as well. All right, Scarlett, we got to get back, I guess, to the broader market here as we count down to the close. Just about 55 minutes until we get there. Melissa Brown, she's joining us right now to help us count down to those bells. She's the Managing Director of Applied Research over at Axioma. Great to talk to you again, Melissa. And I want to talk, just a minute ago, I was showing Scarlett a chart of some of the volatility we're seeing in treasuries, and that's not a news story. But I'm also interested in why we don't see that same type of volatility in the equity space, at least with regards to the normal measures that we look at, like the VIX.
I think it's really interesting that we're not seeing that kind of volatility. It's a little bit puzzling to us. I think, when we see that coupled with low trading volume, I think that it tells us that investors maybe don't know what to do, so they're not doing anything. And as long as they're not doing anything, stock prices are staying within a relatively narrow range on a day-to-day basis. In the third quarter, we saw only a few days where stocks moved up or down by more than 1%, which was a huge contrast to what we saw even in the second quarter. So I think it's just a wait and see kind of approach.
It also raises the question, Melissa, that I think is like, how many people are even in this market? I mean, we know that the folks in the Treasury market have kind of left, at least to a certain extent. And it seems like to a certain extent, when you look at trading volumes, not just the volatility, but the actual volume itself, it seems there's just a lot of people that are just still on the sidelines.
I think that's true. I think when rates started to go up earlier this year or late last year, you did have money move from equities into bonds. I think now with Treasury yields being relatively high, you can certainly get a decent return by just keeping your money in cash for right now. And if you don't have a clear direction of what you want to be doing, you might as well do that.
We talk about Treasury yields being high, but for the week, they are actually set to fall for the first time since September 1st. So what is that? 1, 2, 3, 4, 5, 6 weeks. What is the argument for why Treasury yields may have peaked and are now unlikely to go beyond where they got to at the end of last week?
Well, I think there's mainly speculation that the Fed is done raising rates. And so, the next move when it comes is likely to be down. And so I think that, is maybe keeping a lid on rates at both the long end and the short end, I would say. So, I think that's probably the reason that we are seeing those yields come down. But I would also point out they're still relatively high. They're not going back to where they were, I don't think, anytime soon.
How are you thinking about the correlation between stocks and bonds and what that means for volatility? Romaine was just showing us a chart about how bond volatility has surpassed equity volatility, which is an unusual scenario.
That's a really unusual scenario. We are also seeing stocks and bonds positively correlated recently, so which basically means they're moving in the same direction at the same time. And that has been somewhat unusual. We would expect that, if money's flowing from stocks into bonds, then you're going to get them moving in different directions. So I think both stocks and bonds right now are being influenced by what's going on in the macroeconomy, whether it's in inflation or some recession at some point in the future. And that's causing stocks and bonds to move together.
When it comes to sentiment, there's a lot of talk about how sentiment is really negative, and so that kind of sets us up for a certain reaction if numbers from earnings, unexpected geopolitical headlines come in, people are quick to react. What's your read on that?
Yeah, we're seeing the same thing in the sentiment numbers that we measure. So we are seeing that sentiment is low across the globe. It's not just in the U.S., it's in almost every major region of the world, that sentiment is low. And I would agree that when sentiment is poor, you tend to see overreactions to bad news and maybe underreactions to good news. And so, I think that narrowing sentiment is potentially, setting us up for some problems in the equity markets. I would say in the last week, though, we have seen a move towards buying higher beta or higher volatility names. It's only 1 week. You can't really make any conclusions out of it. But maybe that's a little bit of a bright spot in that sentiment view.
All right, so a silver lining, if you will. Melissa, really appreciate your joining us. Melissa Brown is Managing Director of Applied Research over at Axioma. All right, coming up on the close, the United Auto Workers Union expanding their strike to Ford's biggest and most lucrative plant. We're going to be speaking to the president of that local UAW union about what they have in store next.
Plus, earnings season is kicking off. The big banks reporting some big beats on net interest income, but some big concerns about what's still under the hood. Odeon Capital's Dick Bove going to be joining us in just a second.
And we mentioned how Dollar General stock is getting a lift today after announcing former CEO coming back out of retirement to take the reins. And the guy who presided over a 60% drop in the stock is out. So we're going to get into all the details in our Stock of the Hour. This is The Close on Bloomberg.
All right, you have just about 46 minutes until we get to the closing bells here on this Friday afternoon. Wrapping up what has been a holiday-shortened week, but a very volatile week here. You are seeing green on the screen here with some pretty significant movers up to the upside, but of course, you have some pretty significant movers to the downside. Most of the Magnificent Seven have been on the back foot for a good portion of the day. In fact, they've actually been on the back foot for a good portion of this week. It has been a risk-off mode driven, of course, by the events that unfolded last week. The S&P 500, at least on the day, down about 0.3%. The NASDAQ down about 1% here. But a lot of the big moves, of course, are coming in things that are associated with geopolitical conflict. Airlines down once again 2%. Defense contractors higher on the day. NYMEX crude surging more than 5% on the day. Spot gold surging more than 3% on the day. Even the VIX, which can't seem to find any way to move higher, is moving higher here on this day, back to that 19 level here. And then when you talk about some of the individual stories for stocks, particularly as we head into an earnings season, at least for right now, not necessarily looking good. What we did hear out of the banks wasn't necessarily bad, but remember, it's just 3 and it's still early in the season. But there are some concerns about the AMCs, the JD.coms, and the Netflixes of the world as we move deeper into this earnings season. Abigail Doolittle, she's standing by right now. She is every day around this time for our Options Insight segment. And Abigail, you're actually taking a look at the uptick that we've been seeing in volatility across various asset classes. We were just talking about this.
Absolutely. Well, it's a pretty rare day in the fact that that VIX Romaine. Yesterday, it was below a 16 handle. At one point today, above a 20 handle. So that complacency that we had in the picture just yesterday really kind of getting ironed out today. But it's not just the VIX and stocks. It's also the oil index VIX. It's higher. The gold VIX is higher. The bond index overall remains elevated. To talk more about all this volatility and whether it might become even more, if there could be more volatility on the scene, let's bring in Chris Murphy, co-head of derivative strategy over at Susquehanna. Great to have you with us, Chris. Happy Friday. It's been quite a week, as you can tell by my inability to get my words out of my mouth. But what do you make of this move? Because that VIX yesterday, I mean, it had a 15 handle and then briefly above 20. It's not every day that you see that kind of a move.
No, absolutely not. Happy Friday to you, too. We know that the VIX and the S&P have a negative relationship, and we kind of have an expected move for the VIX when the S&P is down, 50 basis points like it was earlier today. The move that we were seeing in the VIX was 3, 4, even 5 times what we would expect to see. And we really haven't seen that kind of outperformance in the VIX. We had to go all the way back to the day after Thanksgiving for Omicron. So, it's a very, very much outsized move. Like you said, a lot of other volatility readings, skews are going up a ton. Obviously, everyone is kind of gearing up for the chance of increased geopolitical conflict over the weekend. But, it certainly has dislocated. Now, can it last? Now, that's obviously going to depend on what happens overseas. So that's hard to predict. But the biggest takeaway is a much higher increase in volatility over the course of the day, somewhat catching up to bond volatility like the earlier guest had mentioned. So there's an aspect of that as well. But it's a very unique day under the hood.
Now, so for that VIX, is there a way for you to tell whether people are hedging or if there are some people who are outright short, some way to dissect what is really driving that volatility higher?
I mean, it's definitely a lot of hedging. And I also think it is a little bit more risk, premium because of the events that are going on. So, when someone comes in to hedge and buys a lot of puts or a lot of VIX calls, the level for the next purchase is just moving up faster. And you can see that in the VVIX, which is the measure of VIX options. And then, the downside tails when geopolitics heats up like this, those become more expensive. That makes skew more expensive, and that makes the VIX moves more violent, even for moderate moves lower in the S&P like we saw.
So in terms of positioning for this weekend of uncertainty, and here's the VIX index, looks like it's trying to climb back into that range that we had before between 20 and 40. How are you suggesting that your clients position themselves into the weekend, coming out of the weekend, again, knowing the level of uncertainty?
Well, if you don't have the protection on and you're rushing to buy it this afternoon, it is pretty expensive right now. You might just want to lighten up on some positions just because the overall market hasn't moved that much. Or you might want to lighten up on positions and swap into something like a call spread. We're seeing a lot of that recently. We're seeing a bunch of big call spreads out there in the S&P 500. Might not necessarily be people that are super bullish. It might just be people that are saying, I'm going to take some of my chips off the table with my underlying positions, but I want to have some upside exposure. And call spreads are a good way to do it because you're not paying up as much in volatility, and we've had a big move higher in volatility today.
Great perspective as always, and love your spirit for those Phillies. Hope they do pretty well for you and the other folks in Philadelphia. Chris Murphy, co-head of derivative strategy over at Susquehanna. Thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
The UAW entering what it calls a new phase in its strike strategy. The president, Shawn Fain, saying, quote, going forward, we will be calling out plants when we need to, where we need to, with little notice. Adding, I predict there are going to be a lot more strikes on the horizon. The latest plant targeted is Ford's highly profitable Kentucky truck plant. So joining us now is Todd Dunn. Todd is the president of Local UAW 862 that represents the 8,700 workers at that plant. Todd, thank you for joining us today. One thing that caught my attention is how this particular strike, this stoppage at your plant, is being framed as a major escalation. I know you weren't at the bargaining table with Ford when they offered their latest, when what they say best offer, but can you give us a sense of how the talks broke down?
From what I understand, we were making some really great progress, which was good. That's why President Fain avoided picking another target and giving opportunity for negotiators. We made some great strides, but I think Ford Motor Company got a little bit complacent. The last 2 weeks, basically, we got the same proposal pushed across the table, and I think they've stalled. And really, it's sad because, we got workers been out at the Michigan Assembly Plant for 4 weeks and 2 weeks at Chicago. So to take those 2 weeks and not taking them seriously, that put some major changes in, tactics and strategy. So I think this, while it's a bold strategic move, it's the right thing to do because we have to get a future for our union members, and that's what we're going to do.
Todd, right now, each car maker, the union is negotiating separately with each car maker. What do you think of this strategy? Would you prefer what would be the benefits of maybe if you banded together and talked with them as a group? I'm just curious.
So you're going to have so many different strategies within these companies. The corporations have different pathways that they take. But if you took, like we have in the past, and negotiate with one unit, all of our contracts come up about the same time, right, within a few days. And what happens is you'll see GM in the past come out. They'll work for a couple of months. We're sitting, and it drags it out. It kind of disproportionate. It's not. You lose interest. You lose some of the focus from your members. This way, this strategy, we're coming in at the same time. And it also is kind of like, iron sharpens iron. It keeps everybody on their toes. And it's not whipsawing, but it's also a good strategy to be able to have the companies come to the table so they are trying to somewhat compete against one another and get agreement at the same time, if that makes sense.
I am curious. Beyond just pay, Todd, as I'm sure you know, there's a lot of concerns here about the new generation of vehicles, whether it's EV or hybrids or whatever, the assembly process being a little bit more streamlined, or at least not necessarily requiring the same amount of workers that maybe were required when you first sort of stepped onto that plant back when we were just making gas vehicles here. What's sort of the bargaining strategy on that front? Because at some point, it's one thing to say we want to make more for each individual. It's another thing to say we want a baseline for a number of workers.
Well, it is tough as we see the electrification, the EVs come into play, and the industrial combustion engine. Some of those concerns are as we switch to EV, you don't have the transmissions to build. What are you going to do with those employees? The drivetrains, they're different. You see wages, you see the joint ventures that, are not under the master agreement. We'd like to get that under the master agreement. We need to get that under the master agreement. So as we lose these jobs, we can transition and segue to those other areas in the workforce. So this is about our future. One of the things I said was nine other workers, mom and pop shops, vendors, suppliers for every auto worker. So, this is about their future too. If we adversely impact and we lose 1,700 employees here, multiply that times 9. We got to be able to transition into those EV jobs. It's critical. And then you see already in Ford Motor Company where they started out to pay $21 an hour in Glendale, they've already upped that to $24 starting rate, and then talking about topping out at $37. So you wonder how strategies are played into this. I think there's more to it that meets the public eye.
All right, Todd, we're going to have to leave it there. I really appreciate you taking time for us, and we should catch up again as this winds on. Todd Dunn there, he's the president of UAW Local 862 here down there in Kentucky. Let's get a quick check of the markets here as we head towards the final half hour of trading here on this Friday afternoon. Stocks pretty much in the same holding pattern that they've been in for a good portion of the day. Similar story for Treasury yields, which are now once again seeing a flight into Treasuries, pushing prices up and yields down.
Yes. We're seeing definitely a flight to safety here, but what's interesting is for the week, the NASDAQ is down. It's negative 0.1%, while the S&P and the Dow are higher. A lot of movement into industrials and those defense names.
Yeah, absolutely there. And of course, you see the bid into gold. And when we come back from the break, we're going to talk a little bit more about the banks. We heard from JP Morgan, we heard from Citigroup, we heard from Wells Fargo. And of course, we got Goldman and quite a few others on tap for next week. And let's not even start to talk about the regional banks. Stick with us. We'll be back in a moment from New York. This is Bloomberg. This is the countdown to the close. Less than 30 minutes to go here, Scarlett, in the day and in the trading week.
And right now what we have is a mix to lower read for equity markets. The Dow's hanging on to unchanged at the moment, but the S&P 500 and NASDAQ firmly in the red. And a big reason why is because you have losses in consumer discretionary, tech, and communication services names. So those big tech companies are dragging the overall index lower. Consumer discretionary, a lot of retail names, Tesla, Amazon, all in the red. On the flip side, energy stocks up by more than 2%. As oil prices recover, utilities and consumer staples. So some of your safety plays are in favor at the moment. Romaine.
Yeah, let's take a look at some of the individual movers. If you're looking for a bright spot, there are a few out there. Progressive down at the bottom of your screen. The insurance company up almost 8% here. One of the biggest gainers today in the S&P 500. But if you're looking for additional bright spots, you're not going to find a whole lot. You saw energy on Scarlet screens, and some of the bank stocks are doing well on this day as too, including Wells Fargo, higher by about 3%. JP Morgan getting a bid, though Citigroup somewhat unchanged. But take a look at BlackRock here. An interesting story unfolding there when you talk about the market volatility and just how much that spooked people. $13 billion in redemptions in the most recent quarter coming out of the long-term funds that BlackRock has that really rattled investors. Remember, BlackRock has just been a juggernaut of growth when it comes to assets going up quarter after quarter after quarter. So that's been arrested just a little bit here. Whether that's a temporary blip or something long-term that investors need to be worried about, only time will tell here. And we talked a little bit earlier about Boeing, those shares on the back foot as well. But let's stick with the Treasury market right now, because we talk about this idea here of where the havens are here. If you're looking for a haven, you can find it in Treasuries. If you're looking for a return, you might not get it. TLT still right now in the middle of one of its biggest drawdowns that we've seen in years. And we should point out that's actually flipping the script just a little bit on this week. TLT actually on pace to actually post a return, but that would be the first weekly return that we've seen going back at least to the last week of August. And remember, this is now a move, at least this week, that is driven more by geopolitics and less by some of the fundamental issues that had led to that massive Treasury sell-off for a good portion of the year.
Yeah, it's unclear what happens next, but we'll be, of course, monitoring all of that. A big part of it will be driven by what companies are saying when they report earnings. And the first of the big U.S. banks did announce results this morning, with Citigroup, JP Morgan, and Wells Fargo all posting beats. So joining us now for more is Dick Bove. He is Chief Financial Strategist at Odeon Capital Group. Dick, it is always good to see you. Thank you for joining us. Heading into this earnings report all summer long, the theme was downward estimates, revisions due to rising rates and funding pressures. That's a fairly familiar story now. And of course, we're on the cusp of a potential credit cycle turn as well. Someone remarked about how the industry is in a show me phase right now. Based on the earnings reports we got this morning, what is the industry showing us?
Well, I think the earnings reports were quite good, actually. In other words, loan volume was better than people thought it would be. The hit to deposits wasn't as hard as people thought it might be. Margins were a little bit better than expectation, and the loan loss provisions went down pretty substantially. So the net effect is it's hard to find fault with anything that these companies reported in this quarter. In addition to which, there does seem to have been a significant change in the investment banking industry. So the question is that the precursor of a number of quarters which are going to look like this going over the next 2 to 3? And I think the answer to that question has to come down to what you believe is going to happen in the economy. If you think the economy is going to have a soft landing or virtually no bad economic numbers at all, then these bank stocks should continue to be bought. Unfortunately, there are people like myself around who believe that we will have a recession into 2024 and that these banks will face a significant increase in loan losses, that their margins will stay under pressure, that they'll continue to have trouble holding on to their deposits. So again, it really comes down to a macro decision, not a micro decision related to the companies. The companies are showing They know how to run their businesses, and they run them well. The question is, can they be allowed to do that?
Right. So if macro considerations are driving the company's businesses, which banks are executing the best, then, of the ones that you cover?
Well, I like, obviously, I think J.P. Morgan is an outstanding institution, well managed, head and shoulders above, I would say, all corporations in the United States. I'm a Jamie Dimon acolyte, or, whatever they call it.
Fanboy.
Yeah, I think Wells Fargo showed that it was doing better than people thought. I think Wells Fargo performance in the quarter, particularly in the investment banking area, was very good. I'm a big believer in Jane Fraser also. I think that she's going in the right direction in terms of managing her company. And I happen to own that stock myself personally. But the point is that none of these companies can deal with recessions easily. Yeah. And the one, if you will, tripwire that you saw in these earnings this morning was net losses on loans were increasing virtually across the board. And they weren't increasing by a small amount. They were increasing by a meaningful amount. And, I think that the consumer is tapped out. I think the consumer is now borrowing too much money at interest rates that the consumer can't afford. And therefore, I think that's where the problem is going to develop, in 2024. And that would hit it would hit two of these banks. It wouldn't hit Citigroup as hard as it would hit the other two. However, obviously, if the economy doesn't get hit hard, if the consumer can continue to spend money going through this period, then these banks will do well. So I'm giving you a very mixed message. Hard to pick up anything from it. I'd say you can trade these stocks in the short run, but in the longer run, it's not the best idea.
This still gets back to management here, and you talk about being a fan of Jamie Dimon. I thought it was interesting that when he was queried earlier today on the conference call about his competitors, he actually gave a nice hat tip to his former protege, Charlie Scharf, at Wells Fargo, and what he's been trying to do to kind of right that ship. I mean, what do you make of the progress that he's made so far?
I think he's doing a superb job. I think he's proven. He proved when he came from Bank One with Jamie Dimon to J.P. Morgan and took over the retail bank at J.P. Morgan. He proved he knew what he was doing. He did a good job at MasterCard. Not as successful, I'd say, at BNY Mellon, but I think he took a really strong, hard approach when he came to Wells Fargo. You can't find one person in the top, we'll say, 25 executives in that company who were there before, he was there. Mm-hmm. So he wiped the place out. He's dealing with unbelievable problems in terms of the operating, if you will, inefficiencies in the company, and he's doing a terrific job. And I think this quarter showed that. And he also is come up with a concept, to get the bank more into investment banking in a way and not as heavily reliant on, let's say, mortgage lending. Also a terrific idea. So he's doing a great job.
All right, Dick, always great to catch up with you. We're going to have to leave it there. Dick Bove there over at Odeon Capital. A closer look here at three of the big bank earnings that we got this morning. Of course, a lot more on tap as we head into next week. We want to check in right now on the President of the United States, Joe Biden, in Philadelphia at a marine terminal, there to talk about economic conditions, but addressing the situation in the Middle East, saying that his teams are working to surge humanitarian support in Gaza. He also says that he's been working with Israel, Egypt, Jordan, and others on some sort of Gaza aid. A little bit earlier, the president also said that he has been in discussion with Israeli officials as well on their side and the efforts that they are making. We'll be back in a moment. From New York, this is Bloomberg.
That's another issue. Folks, the press started calling this my plan Bidenomics. Today's announcement is a critical piece of that plan. Let me explain. I made it a goal for
All right, it's time now for our stock of the hour. Let's take a look at Dollar General, a second worst performer in the S&P 500 on a year-to-date basis. But for today, It's your best performer out there on a percentage basis, up more than 9% after the former CEO said he's going to return to lead the discount retailer. A potential changing of the guard after a Bloomberg Businessweek report detailed safety violations and poor working conditions at the company. Nora Melinda joining us right now, equities reporter for us here at Bloomberg News. And Nora, there's been a lot of anecdotal evidence, a lot of news reporting about the working conditions at this company. Ultimately, was that what led to the departure of the CEO?
Well, of course, under leadership of Jeff Owen, shares have really been plunging. They have not been performing nearly as well as they did under Todd Bezos, who is the incoming CEO and was a former CEO of the company for about 7 years. He's really known for leading 7,000 stores for Dollar General, as well as really just being an amazing CEO. But the store has really been facing a lot of scrutiny due to the rat infestation reports, employee retention issues, and of course shrink, which has really been hurting a lot of these consumer names. But a lot of these names like Dollar General and Dollar Tree have seen a little bit more resilience during this time period, because we do see consumers running toward affordable names as opposed to some of the higher ticket stores that they could end up at.
So that's a really interesting point, given that the excitement, or I should say the outlook for dollar stores is probably a little bit better now, given where we are in the economy. So the company wants to take advantage of that pickup in interest and make a change here. What's the general investor sentiment regarding a change in management? Is this something that investors were clamoring for?
Well, this is obviously showing really positive trajectory today, as we are seeing it as the biggest gainer in the S&P 500 today. The stock is up its most since May of 2022. So investor sentiment is really positive. I'm hearing analysts saying that while it may not be an immediate fix for the company, it does seem like this could be a positive trend for them, and they may be able to really bring in some growth. But we do know that the company has still lowered its full year earnings guidance just 1.5 months after providing it. So as we head into earnings season, they do report earnings on December 1st of this year. And analysts are really watching just to see how the company will be able to recuperate.
And well, again, it gets to the longer term story here as well, Nora, this idea that obviously Vassos isn't necessarily going to be there as a long term solution. I would think not, right?
Right. I mean, there is some speculation surrounding that, but I do think that it does seem like it's going to be more of a acute fix to the problem. Obviously, since Jeff Owen did have a very interesting history with the company, but we do need to see like what these long-term solutions will be for the company and what that leadership will look like moving forward.
Nora Melinda there covers equities for us here at Bloomberg. A look at our stock of the hour, biggest percent gainer today in the S&P 500, Dollar General. Meanwhile, the broader market still remains in the red as you round out into the final 15 minutes of trading here. Ed Clissold going to be joining us in just a second over at Ned Davis Research to help us count down to those closing bells. Stick with us. This is Bloomberg. This is the countdown to the close. I'm Romaine Bostick. Scarlet Fu still with me here as we count you down to the closing bell and, of course, beyond, Scarlet Fu.
Yeah.
We still haven't figured out what's beyond, but I'm told it's good.
On a Friday, it's always good.
Not necessarily a good week for the market, a good day, I should say, for the markets here. I think the Dow Jones Industrial Average, really the only major indice or average out there right now in the green.
Yeah, clinging on to its gain for now. But I guess no one wants to be long before a weekend in which there's a lot of uncertainty, right? I mean, there's concern that the conflict in the Middle East might get to a new level with Israel preparing for a ground invasion of Gaza. So treasuries, there is some support there. And so as a result, you see yields coming down. And in fact, yields are going to be down for the first week in about 6 weeks since early September. Yeah, you wonder how much of that's going to be lasting, whether this is a kind of a meaningful shift or this just is kind of the short-term reaction to the issues going on in the Middle East and whether that's resolved. I mean, we were remiss, though, in not talking about the fact that
next week is a busy week for earnings. I mean, I think we get like more than 70 S&P companies.
Yeah.
And I know we, there are a few that aren't going to tell us the whole economic story. But I wonder if that ends up becoming a catalyst, either positive or negative for the market.
I think a lot of investors are looking forward to the idea that company fundamentals will retake center stage as opposed to every utterance from every Fed official or every economic data point, giving us some sense of inflation expectations and driving all the assets together in one direction or another. But we'll see. Tech earnings is going to be the big test, right?
Yeah, I think so. And of course, we get just a smidgen of those companies next week, obviously Netflix among them. And then we got to wait for another week to get the real big daddies here. But nevertheless, it'll give people a little bit of a sense here as to where we're going on a fundamental basis. But of course, the geopolitical concerns still front and center. Ed Clissold joining us right now, Ned Davis Research Chief U.S. Strategist, to help us count down to the closing bell. And Ned, I want to ask you who your favorite Fed member is, or at least the one you like to listen to the most, because my guess is we have to listen to all of them. But are we at a point now where we can, as Scarlett pointed out, focus on the fundamentals? I mean, and I know that I asked that question with obviously the Middle East situation looming in the background, but I think that's what the market had really kind of been waiting for months now.
Yeah, there was so much focus over the past several months on what the Fed is going to do next. And they seem like they've guided, at least for the next couple of meetings, probably one more hike for the last two of the year. Maybe it is time to reintroduce things like how much money does a company make to how much the value of the company is. But what we're going to be watching this earnings season is the quality of earnings. So last quarter, the beat rate, or percentage of companies that exceeded expectations, was quite high for the S&P, about 80%. And if you take away the couple quarters right after the shutdowns, that's actually a record high. But what didn't come through, Romaine, was the sales beat rate, the percentage of companies that beat on the top line. That actually fell to its lowest level since Q1 of 2020. So companies managed costs pretty well as inflation came down, but there's a lot of manipulation under the surface too. And so what we'd like to see is companies really doing well on the top line in addition to kind of managing expectations to the bottom line.
Do you think that sentiment, though, Ed, is shared by the broader market overall?
Well, I think most people do just look at the numbers and say, hey, did they beat, did they not? But you start to notice, like, over time that the companies that do raise their guidance, that the companies that do consistently beat on the top line, they tend to outperform. So I think it does matter. Whether or not it matters this week or this month, remains to be seen. But over the long run, those things do tend to bear out.
So as we head into this earnings season, and yes, we got the big banks, but in some ways, the big banks no longer really represent the broader economy. They're kind of a reflection of monetary policy. What does sentiment look like? Because that will help determine what kind of reaction we get in the market to each of these earnings reports.
Yeah, so we have a couple sentiment gauges, Scarlett, where we combine lots of things together, like the VIX, put-call ratios, also polls of individual and institutional investors. And we have one that's short-term, looks out a couple of weeks, and one more intermediate term, looking out a couple of months. Both of those had actually gotten down into what we call extreme pessimism. So after the 8% decline in the S&P over the past several weeks, it was enough to get the weak buyers out of the market. And so there's room for the market to react positively to the earnings news. Whereas, say, last quarter, actually, even though there were a lot of companies that beat on the bottom line, the market didn't do that great because our sentiment gauges were quite the opposite, showing a lot of optimism at that point.
I know you guys also crunch a lot of numbers in terms of earnings estimates and what's likely to outperform or how much estimates have come down. We know for the financials, they were coming down for much of the summer. Where is there still more room for estimates to come down as we get into the meat of earnings season?
Yeah, so I think if we can focus on the real economy, what's going on in the industrial sector, what's going on in the retail sector, those would tell us how the consumer is doing, how businesses are doing. Do they feel comfortable investing in CapEx, or are they kind of managing their expenses to beat earnings estimates that they've guided to already? That'll tell us how the economy is doing overall. Because as we move into next year, we're going to start have to ask ourselves how strong the consumer really is, with things like Social Security cost of living adjustments being much less, the excess COVID savings running down, and restarting of college loans being had to be repaid. These things are all going to individually bite into the consumer. So hopefully there's strong consumer momentum going into what will be some headwinds for the consumer next year.
The setup, though, to that seems a little iffy. I mean, even when you look at kind of some of the stocks that are tied, more closely tied, at least, to economic conditions, you haven't necessarily seen a strong bid come into that, whether you're taking a look at small caps, whether you're taking a look at some of the cyclicals, or even in some of the industrial sectors where you think there would be a little bit more interest.
Yeah, so small caps are really interesting to us because, as you said, Romaine, if the economy is going to accelerate, they should outperform. So one of the most consistent areas over time to focus on as the economy accelerates, and they have struggled this year. And usually during the first year of a bull market, which we're basically at the 1 year anniversary of a bull, small caps tend to outperform, and they haven't. So I think that tells you a couple of things. First of all, that higher rates have really started to bite. So investors haven't focused on companies just for their sake of how they're doing with the overall market. Instead, they're saying, give me companies that can grow really quickly, i.e. the mega cap growth names, and then I'll just put some other money getting 5.5% in cash. But the other thing is that companies that are facing higher interest expense, which small caps have struggled more with that than large caps, they are suffering from the higher interest rate environment.
From the small caps to the big caps, do you expect there to be the similar kind of excitement over AI and any discussion of AI as we've seen in previous quarters?
It's going to be front and center for those companies that are developing AI, and if that enthusiasm can continue. What we're a little more skeptical on, say, over the next few quarters, is whether that's going to percolate through the rest of the economy. Yeah. The way these things normally work is excitement's there first, and then the reality does come through, but it takes a while for the other sectors to be able to implement the technology.
All right, Ed, always great to talk to you. Ed Clissold there over at Ned Davis Research. Have a wonderful weekend. Meanwhile, Scarlet Fu and I are still sticking around with those closing bells. Just about 2 minutes away here, Scarlet, and we talk about a market that is not only trying to adjust to whatever the Fed is doing, whatever economic conditions are, and of course now an earnings season, but of course the geopolitical situation unfolding.
There's a lot of moving parts, and there's a lot of concern that inflation will be rekindled because of the geopolitical events. I mean, that was already a concern given that the economy was holding up better than expected. But now you've got a different catalyst altogether.
Absolutely, and you saw that reflected, of course, in the big spike that we saw in the WTI crude and Brent crude, for that matter, today. In fact, the biggest one-day gain we've seen there in several months, and a big flight to a lot of those haven assets. You were bringing up gold a little bit earlier. Yeah,
gold prices moving past $1,900 an ounce, moving above the 50-day moving average. So that was seen as a breakthrough. What's curious, though, is that big tech has traditionally been a haven, or it had been for most of this year, and today the Nasdaq is off by 1.3%.
Yeah, I wonder how much of that has to do with maybe valuations, the idea that you're heading into an earnings season. Do you want to be in front of that as a safe haven when you don't necessarily know what those reports and, more importantly, those forecasts are going to show? Interesting setup, though, as we head into the weekend, and who wants to hold into that weekend, at least as far as the short-term traders. As far as the long-term traders, the narrative is really kind of the same that we've had for a good portion of the year. A macro-driven market still being battered around, an S&P 500 lower on the day by about 0.5% as we wait for these numbers to settle. A second straight day of declines for the S&P, but never mind that. The 3 days prior is going to be good enough to give it a weekly gain, second straight weekly gain. A similar story for the NASDAQ composite and the NASDAQ 100. Down on the day more than 1%, but up on the week more than 1%. And the Dow Jones Industrial Average, one of the few bright spots on the day, but only fractionally. A gain of about 0.1%. Now back to that 33,670 level here as it tries to sort of claw its way back up to 3,400. A gain on the day, a gain on the week. The Russell 2000, not so much here. Down on the day and down on the week. We were just talking with Ed there about that cyclical trade and that small cap trade. Not a lot of people really want to embrace that.
Yeah, especially if rates are going to be higher for longer. That means more pain for the small cap companies, which of course struggle more from rising interest expenses than the large caps. All right, let's take a look at the large caps and how they look when you look at it on a sector basis. Energy stocks, no surprise there, given the rise in oil prices up by 2.25%. Healthcare equipment and services companies, also the insurers, very strong today, up 1.5%. The best performers in the Dow, for instance, United Health Group, an insurance company, Travelers Companies, also an insurance company. On the downside, that's where you see big tech really coming in. Autos and components, led by Tesla, off by 2.8%. Chip companies losing 2.8% as well. And media and entertainment. Netflix reports earnings next week, doesn't it, Romaine?
Yeah, we get about more than 70 S&P 5 companies set to tee up next week. Maybe that changes the complexion of this market. Maybe not. Let's get some insights out of our cross-asset aficionados here. The best of the best. Jess Menton joining us right now off the plane from Texas. And Bailey Lipschultz, the pride of Syracuse University, also stopping by here to kind of walk us through some of the big movers that we've seen on the day and on the week. Who wants to start here?
I can go.
All right.
So I'll start off with some bright spots here for today's close. So we knew that the big banks were going to report. So JP Morgan closing up 1.5%. So best day in a week there. But for the most part, when you're looking at what's happening with economic growth, even though executives during this year, and when you think back to a year and a half ago when Jamie Dimon first mentioned that sort of hurricane type weather forecast about the economy.
A year ago?
Overall, yeah, I know time flies, right? But actually, when you're looking at some of the underneath the hood there of these numbers, and especially with net interest income coming in at a record again, boosting its outlook for its profitability this year as well. Things coming in stronger there. But then I have to point out, though, when you do have these other banks reporting too, like Wells Fargo, Citigroup, overall, you're starting to see kind of a consensus with as far as bad loans are beginning to grow a bit more, even more so than, say, before the pandemic. So that's something that people are keeping a close eye on to see what kind of a trend can develop more from there. I'll also point out another big gainer today. So Dollar General, ticker symbol DG on that, up 9%. So that was its best day since May 2022 there. And so when you are seeing Dollar General shares jumping like that, it did come on the back after CEO Jeff Owen did step down. So this does come nearly a year in that role during which those shares did plunge.
Right? Well, I mean, like if I got fired from here and then all of a sudden, like Bloomberg's valuation just took off, I would take it kind of personal.
Well, also, I mean, they're bringing back Todd Vassos. So he actually served as CEO from 2015 until 2022. So he's back at the reins there. But also this does come on the back. Last month, we did hear from Dollar General, and they had cut some of their forecasts there because a lot of the competition, even within not just other bigger retailers, but for the dollar stores as well, it was struggling too.
Does this feel like Bob Iger and Disney a little bit, just a little bit?
Oh, in a sense, that's an interesting example there as far as when that comes back and you have that kind of big name coming through at a particular scale. But I feel like maybe in some comparisons in the sort of retail space, maybe that is what's going on there. In that
the environment's different, clearly, for Todd Vassos the second time around. He's going to spend his time cleaning up things as opposed to taking a victory lap.
And they did say he would be there for the, quote, foreseeable future. And that stock's down over 50% year to date.
But he's not necessarily the long-term solution. Bailey, is Ryan Cohen available? Does he have anything that he wants to contribute to this?
He probably could trigger a meme stock rally. I'm not going to lie, if he disclosed a purchase.
Oh, I'm sure.
Without a doubt.
Yeah, but I think he's kind of got his hands full. What else you got, Jess?
So I'm also looking at Progressive there. Stock ended up 8% higher today, best day since August 16th of this year. So did topping.
Yes,
so insurance there. Also, I'll point out at a record today.
Oh.
So that stock. So seeing that there, but then also obviously topping those expectations when it does come to the third quarter earnings results. But then also when you're looking at the S&P 500 insurance index today, also climbing. So you do have Allstate and others that did gain on this too.
Well, they've been raising their rates pretty aggressively, all those insurance companies.
Right.
That's showing up in the bottom line, I guess.
All right, we got there's some big decliners today too, Bailey. You've been quiet here.
I know.
Is this what they teach you at Syracuse? I even wore my orange for you.
I like the double orange and the blue. Syracuse is going to lose to Florida State by about 35 on Saturday. But anyway, looking at other losers,
that's our betting line on the day.
A lot of big tech in the red. But looking at individual laggards, Boeing falling a little more than 3% after continued issues with their 737 MAX aircraft. It seems like this has been a saga that cannot stop dogging this company, closing at the lowest level since December 2022. That was weighing again on some of those providers of those gears. So you're looking at Spirit Air, ticker SPR, and a number of other companies that help make money when Boeing sells planes, throwing into doubt whether or not they're going to be able to meet those expectations.
It just can't catch a break here. It just continues, the story.
It's really a struggle. And another underperformer looking at the airline space, Delta Airlines falling Today, you're looking at this weakness for the week. S&P 500 Airline Index, S5AIRL, down more than 7%, worst week since March. This coming, obviously, as crude oil prices are rising, a lot of uncertainty around investor demand. If we do see consumers pulling back some of that spending, you're seeing weakness in airline stocks, you're seeing weakness in cruise line stocks, and really just a lot of uncertainty around where the consumer is going, especially with oil where it's at.
I like that you use that index. I used XAL, the New York Stock Exchange ARCA Airline Index.
Ooh.
Yeah, just as an alternative.
Now I got to add another one to my list.
Just throwing it out there.
And another stock, I know we talked about this yesterday, Hormel Foods, maker of Spam, continuing to be under pressure. Analysts still uncertain about them tightening spending for next year, really viewing it as a transformation year, especially in an environment where people want to avoid risk and focus on profits. No one really wants to hold a stock or a company that's really trying to revamp its image. That stock, after yesterday's drop, worst day since 2008, closing at the lowest level since 2017. So continued issues for consumer staples sector.
Revamp its image. It has a bad image. I thought everyone loved Spam.
Scarlett said that she is a huge buyer of Spam.
Wow. So we've learned a lot this week. I mean, because I learned that she has about like 28 pairs of Birkenstocks.
Every day it increases by 10.
And now she's got a cabinet full of Spam.
Stock. I mean, Bailey's remember that stat? What was it? 17.
I'm surprised you didn't bring up Birkenstock today.
I brought it up yesterday. Now down to 21% from its IPO.
This is insane. Before I want to ask you a little bit about Birkenstock, but before we run out of time, I just want to walk us through what happened in yields today and really on the week here, because we talk about not just the change that we saw, obviously a drop in yields on the day and on the week, and probably one of the most significant drops that we've seen in yields, at least going back to the summer. But so too was the biggest jump in volatility that we've seen as well. And last time I checked, sovereign debt in the world's largest and in theory safest economy shouldn't trade like a Ryan Cohen meme stock.
No, it is concerning. And when you saw, it feels like it's been so long since we've seen an auction happen where the market across the board reacted as viciously as it did. And I know that's something Jess paid close attention to yesterday, and it really did throw a wrench in the trading day. And that's one of the drivers that you've seen really over the last day and a half of trading.
Right. And just how strongly that correlation between stocks and bonds is. So Bloomberg Intelligence has it as the most closely tied in about a quarter of a century. So obviously that has broad implications there in particular strategies.
Well, can I ask you both this? Because we've heard from a lot of folks on the show about that positive correlation. And the idea, I think Ed Morris has talked about it, Ed Yardeni, and a few others, that this is here to stay, that the idea is that the negative correlation was probably more the anomaly than the positive correlation.
Well, also that negative correlation went for the most part over the past 2 decades because you're in a different environment where inflation for the most part was a lot lower. And then also the Federal Reserve tended to have rates at historically low, especially coming out of the housing crisis. So that's why you're seeing that flip of a dynamic. And it was opposite, say, in the 80s where the correlation was higher, not surprisingly, when inflation was also higher.
So where do you go to find safety? I mean, where should we go? Where should people go?
Well, apparently people are still going into particularly U.S. stocks, as you've seen. I mean, obviously we've seen different weak points there, but I mean, overall, when you're seeing the trade, especially during different geopolitical events, we've still seen people go into those stocks.
I was going to say Birkenstocks.
I do, before we go, I do want to give Bailey a last word, and this kind of gets to a question that Scarlett has repeatedly asked and not gotten an answer of, and that is about, have some of those big tech stocks kind of lost that defensive veneer that we had saw earlier this year?
I'd say yes and no. The valuation is always going to be the big debate when you're looking at the Magnificent Seven. But at the end of the day, when you talk to money managers, they feel safer putting cash in an Apple and investing in an NVIDIA as opposed to worrying about, flocking to the likes of gold or oil as other hedges. It seems like that still is hard to shake. Whether that Magnificent Seven becomes a Magnificent Four is a question for another day, but that still seems to be the sentiment that I've gathered.
They're minting money. They will continue to mint money. Maybe they're expensive, but they will continue to mint money.
All right, nice wrap up here by our cross-asset reporters, Jess Menton and Bailey Lipschultz. We'll catch up with them again on Monday. Meanwhile, we have to go back to some of the big issues still focused that the market is focused on, and that includes the House of Representatives here in the U.S. and the lack of a permanent Speaker of the House. We're now learning that Jim Jordan has been nominated to be Speaker by the GOP. This is his own party. They held a secret ballot just among their own members, and they have decided to nominate Jim Jordan. Now, remember, he was in the running just, last week to be Speaker of the House, but most of those folks decided in that straw poll that they would go with Steve Scalise, who withdrew after realizing that he was not going to win a floor vote. It's now Jim Jordan's turn to run through that
Okay,
gauntlet.
my head is spinning from what you just said, because there's too many people changing their minds, agreeing to something, then changing their minds, and in the end not having anyone lead the conference.
Yeah, and we're also getting reports out of Politico as well as some other news sources that some Democrats are trying to broker some sort of compromise with Patrick McHenry, who, of course, is the pro tem Speaker of the House right now. So you got your civics lessons that you slept through back in 6th grade here today on the close. Big part of the reason why we're here. Stick with us. We'll be back in a moment. This is Bloomberg. A relatively weird week when it comes to global financial markets, but the net effect of it all was actually most of the assets actually were higher on the week. You saw that in stocks. You saw that in the commodity space. You also saw that in the FX space. Unfortunately, some of those gains weren't necessarily for the right reasons, meaning a stronger economy, more certainty about the Fed, et cetera, et cetera. It was much more about the uncertainty around macroeconomic conditions and uncertainty, of course, about the situation unfolding in the Middle East between Israel and Hamas. You see the red line there. That is actually your global aggregate index tracking bonds across the world. That, too, remained in the red. But then you look at the TLT, which, of course, just focuses on sovereign, long-term sovereign debt here in the U.S. And believe it or not, on a weekly basis, you actually ended up with a return here. So a bit of a bifurcation in this market, something that, of course, will have to be reconciled over the next few days and weeks. But before we get there, people are still on edge about the response that Israel, the military response that Israel might be unfolding over the next few days in the Middle East here. That put a big bid all week long under defense contractors here in the U.S. The main Bloomberg index tracking those names like Northrop, Lockheed, RTX, and General Dynamics up 5% as a group. Meanwhile, you see oil and gas stocks also rallied here on the day. The XOP, a 6.5% gain on a weekly basis, as you saw a huge uptick in WTI and benchmark Brent crude. The Magnificent Seven, not so Magnificent Seven, at least on a weekly basis. But don't forget, we do start to get earnings out of some of those names next week. So that could actually start to shift just a little bit. I do want to talk about one of the big flops of the week, and that was Birkenstock. There was a lot of optimism of that company coming to the public markets. $46 a share. That's good for them, but we saw in the secondary market that could not hold. A close today at around just above $36 a share, and it raises a lot of questions right now here about the exit strategy for some of these venture capital companies. They had seen a little bit of a glimmer of light here for IPOs to bring something into the market here, and you saw on the far end of your screen there the big uptick in Q3 that we saw. Obviously, it doesn't match what we've seen in previous months, but that had given people some hope. You do wonder, Scarlett, though, with ARM, with Birkenstock, and with a couple other names that really haven't performed well since they debuted, whether that shuts the door deeper into Q4.
Yeah, absolutely. It's something we'll continue to watch for. Birkenstock, by the way, finishing the week down 21%, despite making its trading debut. I want to go back to sovereign debt, though, because the bond market was where the action really was this week. And it seems like Wall Street investors and veterans are bracing for more pain in U.S. Treasuries. And this is because of a changing of the guard among the biggest buyers. Instead of foreign governments, U.S. commercial banks, and the Federal Reserve, more price-sensitive investors like hedge funds are piling into Treasuries. So, of course, we had to bring in Bloomberg's Liz McCormick, who wrote the story on this. Liz, there's a lot of talk about the marginal buyer, and it looks like professional investors are the new marginal buyer.
Yeah, and this has been a growing trend, Scarlett, but it's more troublesome with all that you guys have been talking about. I mean, I know we have some haven demand going on, but the backdrop has been, right, trouble in the Treasury market and bonds in general with the higher rates and inflation being sticky. And now people are saying in that dynamic, this supply-demand issue, let's call it that, where there's a lot more supply coming. Treasury on November 1st has a new refunding. Most dealers think they're going to announce a new round of increases. But you have kind of those, let's call them steady eddies, who just have to buy. The Fed, other central banks, commercial banks, when they were buying for regulatory reasons, they're not there anymore. And so now you have hedge funds, asset managers, and those types who it's their job to be, want a better price, right? So it's not like the Treasury's not going to sell their debt, but they have a buyer base that's a little more price sensitive. The U.S. government may have to pay up a little. At the least, people are saying you're going to see more volatility. So I think that, like someone we talked to in the story who I think really nailed it right, that when you have the situation where a recession is not going to bail out the bond market in a sense by, everyone buying it, then the supply-demand issue becomes even more of a problem. So I think that's what we were looking at this story, that it just adds kind of another one of the headwinds to the marketplace.
Yeah, and we saw that with the 3 auctions this week. With these professional investors, hedge funds and the like, are they creating the volatility, or are they attracted to the market, to treasuries, because of the volatility?
Well, you know, I remember the days of QE. Some people I knew from the trading days were always like, oh, my goodness, the Fed is killing us because there's no volatility. We can't trade. So to your point, more volatility is attractive. But I think, you know, they're doing various different trades. You know, I won't go into the litany of that they like, but they also like to buy treasuries if you can make a directional bet, or you could do it against the futures, that kind of thing. So I think they're helping create volatility because they're bigger movers. They're not like buy and hold people. So they kind of add to the volatility. But of course, traders like to trade. So volatility kind of incentivizes people to do things. So it goes both ways.
How much of a factor, Liz, has the drawdown by the Fed been in terms of its treasury holdings?
Well, you know, it's interesting, Romaine, because for a while that seemed to be humming along in the background, and people, you know, we don't have an issue right now of what they call reserve scarcity in the money markets, although, you know, reserves are going down a bit because there's some other facilities, like let's talk about the Fed's reverse repo facility. But I did speak to someone who's very smart, been in markets, and, you know, former official person saying, you know, there's going to be a point where that QT starts to bite more, you know, that every dollar for dollar when there's no money sitting in the reverse repo facility is going to sting more. So I think the double whammy of the Fed sticking high, who knows if they'll do more, but they're not cutting soon. And this, I mean, the Fed has put the numbers at about $1 trillion a year at full pace, that this quantitative tightening is, you know, rolling off their balance sheet. Yeah. So that's definitely added. And they haven't kind of pushed back and said, you know, we're going to change things.
But you saw, I'm sure you saw our coverage, Roberto Perli, who gave a speech a little bit earlier this week in Dallas or somewhere in Texas, I believe, and where he kind of talked about the risk. And one thing I thought was interesting, he basically said that he's seen less activity in the repo market, but at least for right now, he doesn't think we're going to see a repeat of that big sort of blow up that we had, right after the pandemic started.
Yeah, exactly. And Roberto's uber smart. And I think he's right. Right now, and Chairman Powell in his press conference has said, hey, like, we learned from the last time, we're watching. So I think they're going to work very hard. So I'm not saying we're going to have another repo blow up. In fact, I don't want to live through another one. But I think that it is kind of adding to the tightening in the system and making liquidity less available, which is ultimately what they want by tightening. So I think they're trying to walk the fine line of not having issues. And Roberto, of course, is smarter than I and right that we don't have it yet, but it's on everybody's radar that, you know, to watch out for.
All right, Liz. Well, you're pretty smart as too. Anyway, Liz McCormick, who helps lead our coverage here, cross-asset coverage here at Bloomberg. We want to stay on this topic right now because, of course, investors are focused on what the Treasury departments and what fiscal spending is doing, but they're, of course, keenly in tune with what central banks are doing as well. ECB President Christine Lagarde says the key to bringing down inflation in Europe is having an open mind and patience. She sat down with Tom Keene at the IMF World Bank meetings in Morocco. Take a listen.
I think what's critically important is that we have an open mind and we have the humility to accept that we don't know it all, number one. The instruments that we have been using need to change and evolve and adjust and integrate new components that we haven't had on our plate. And I think that applies to models. That applies also to our communication. That applies to many factors that certainly have an impact on our job as central bankers. And if we do all that, I'm sure that we can get to where our mission drives us to be, and I'm not going to repeat myself, but it's something that is embedded in the DNA of central bankers, which is that price stability obsession that we have in order to facilitate the unleashing of economic forces for the better. I would just mention one thing, which is time management. I mean, the whole debate about transitory team, not transitory team, and all that is in a way a reflection of our relation to the passing of time. And the movement that we have observed more recently from our audiences, whether it's people in the trade, analysts, observers, but also the general public, which expect instant results, instant gratification, in the face of what monetary policy can do, in the face of how market forces respond, which has always an element of time lag and requires patience. And to actually be able to communicate that and come up with the narrative that will be convincing enough so that those who determine inflation expectations, for instance, appreciate that patience will be needed, that it's not going to just happen instantly as you move from one game to the other. I think it's something that is a challenge for all of us policymakers.
ECB President Christine Lagarde speaking a little bit earlier at the IMF World Bank meetings in Marrakesh, Morocco, Scarlett. And I mean, I understand her point about time and the idea of patience. But of course, anyone in finance knows, their whole job is time, value of money. Yeah. And I think it's a big part of the reason why so many people are on the sidelines, because right now they don't really have a good idea of that timeline.
Absolutely. I wonder if Christine Lagarde ever thinks, I want to make my job more challenging. What if I could fold in full employment into my mandate and just make this a dual mandate?
Yeah, she's got a lot on her plate. And we should point out, as she was speaking there, you saw Agita Gopinath also there. And she kind of echoed Lagarde's sentiment. So she's not alone in this. And remember, there was a communique that they put out that also sort of echoed a lot of the same things as well. All right, we got a lot more coverage coming up after the break. We're going to take a closer look here at startup culture, venture capital, and a big event held in Buffalo, New York last night. That's coming up after the break. This is Bloomberg. A lot of old industrial cities here in America are looking for new economic lifelines, and there's a group of people out there that think that funneling more money into entrepreneurship is the answer. That was the design behind 43 North. It's a startup accelerator in Buffalo, New York, and they held a big competition last night up there at the Shays Theater, awarding $1 million to 5 different contestants who pitched them over the course of 2 days here about their startup ideas. I had a chance to sit down with Steve Case. Of course, he's the founder of AOL and now runs a couple of venture funds, who's been a big part of this event for some time. Let's take a listen as to what he had to say.
250 years ago, America itself was a startup. It was just an idea. And like many startups, fragile, almost didn't make it. Mm-hmm. But there was a pioneering spirit, a can-do, take risks, take chances, kind of spirit, people moving here, moving across different parts of the land. Mm-hmm. And somehow this country, this startup nation, led the way in the agricultural revolution, and then pivoted and led the way in the industrial revolution, and pivoted and led the way in the technology revolution. So the question is, how do we continue to do that? And we can only do that, in my opinion, particularly as we've seen more competition globally from China and others, if we really are getting everybody everywhere who has ideas, giving them a shot and turning those into real companies. That's the best way to make sure America leads. That's the best way to try to unify a divided nation. It's also the best way to create hope and opportunity in each city.
A choppy day in financial markets to end a choppy week. You did see stocks here on this day move significantly lower pretty much across the board, with the Dow Jones Industrial Average the main outlier, but that was only higher by about 0.1%. Now, on a weekly basis, the Dow, the NASDAQ, and the S&P did manage to boast another week of gains, while the Russell 2000, though, stayed mired in the red as no one is quite ready to embrace some of those small caps and cyclicals. Of course, the big news this week really revolved around what we saw in the FX space, what we saw in commodities, and of course what we saw in the Treasury market. A big bid into some of those haven assets that pushed yields down for the first week in more than a month. A big haven bid into gold, into other areas, including the dollar and the Swiss franc. And of course, we saw that big bump up in WTI crude, particularly here on this Friday, one of the strongest days that we've seen to the upside in several months. Scarlett, a big setup here as we head into next week, and more importantly, into a weekend where there's still a great deal of uncertainty about the situation in Israel.
Yeah, and that would explain why so many investors sought out safe havens, didn't necessarily want to be in risky assets like stocks. Let's go to what's happening in the Middle East, because we know that Palestinians in northern Gaza are heading south after Israel gave residents 24 hours to evacuate. This is a task that the United Nations calls impossible. There's also big news on the efforts to normalize ties between Saudi Arabia and Israel. Bloomberg's Nick Wadhams covers national security and joins us now. Nick, let's start with the development in terms of Saudi Arabia pausing diplomacy to normalize its ties with Israel. What can you tell us?
What we're hearing essentially is that Saudi Arabia is telling the administration that while they do not want to completely suspend conversations or diplomacy around normalizing ties with Israel, essentially they need time to see how things unfold. So you have Secretary of State Anthony Blinken in the region. He's actually headed to Saudi Arabia, and the administration really wants to push this forward. But I think at the same time there is a recognition essentially on both sides that Israel is about to launch a major ground campaign into Gaza after having told people to evacuate. And at the moment, all eyes are really focused on that crisis situation, and normalization and the broader diplomatic effort is going to have to wait till afterwards.
Well, I am curious, Nick, as to what do we know about the evacuation of those folks? I know there's already been some communication by airlines that have set up some communication about not only getting people out of Gaza, but of course some Israeli folks out of Israel itself here. But when you talk about 1 million or more people trying to evacuate from that area there, particularly 1 million people that, let's just face it, aren't necessarily going to be welcome in every country around the world.
Well, right. I mean, there are a couple of things going on there. One is that the Gazans, the people, Palestinians in Gaza are headed south. There's not a lot of places for them to go. Some of the border crossings out of Gaza are closed, so they really don't have very many options. And that really is what's prompting the concern from the EU and the UN. They say, wait, you're telling them to leave, but where are they supposed to go and what are they going to find when they get there? Food, water, shelter, things like that. So, and as you say, that's 1 million people trying to move in a very short period of time. At the same time, there is the Israeli issue. So the U.S. is saying, okay, if you are a U.S. citizen in Israel, we will give you a charter flight out of the country if you don't feel safe and you can't get commercial flights. So there's no evidence right now that Americans are fleeing Israel en masse. There's no evacuation order or anything like that. But that's the U.S. basically saying, if you want to get out and you can't because you can't get on a commercial flight, we will help you out.
Okay, so as American citizens perhaps leave Israel and the region, we have U.S. officials there right now. You mentioned Antony Blinken heading over to Saudi Arabia. Lloyd Austin, the defense secretary, traveled to the Middle East as well recently. What plans do U.S. officials, does the Biden administration have to further engage with the big players here?
Well, Secretary Blinken was in 4 countries today doing basically classic shuttle diplomacy, trying to keep this thing from spreading into a broader regional war. So he's headed to Saudi Arabia this evening, and then he'll have more talks in the United Arab Emirates. So really what you're seeing by the administration is a push to get those allies to exert whatever leverage they can on Egypt and other countries to either receive Gazans who may be fleeing the conflict, but also to exert what pressure they can on Iran to keep this thing from spreading into a broader war.
All right, Nick Wadham's down in our Washington bureau here. A look at the situation in the Middle East. We do want to break from geopolitics for just a second and go back to corporate fundamentals. Pfizer coming out with preliminary results here, and they are not good. The company says it sees a full year adjusted EPS at $1.45 to $1.65, and the problem is that's about half of what it had guided to before. The guidance prior, just to put this in perspective, was $3.25 to $3.45. Now they're blaming a complete drop that they're seeing in COVID-related revenue. So remember, this was a company that really had ridden that wave, Scarlett, when it comes to the revenue generated from COVID treatments and vaccines and such. Basically, that is now gone. The company is now saying that it is focused on cutting costs and has a cost realignment program that will cost the company $3 billion, though it does expect about $1 billion in savings for this year and $2.5 billion for 2024.
I mean, it basically has to re-steer its entire strategy because it was all in on COVID vaccines for so many years, and now they're cutting their 2023 outlook for Paxlovid revenue by about $7 billion.
And we should point out, the company is saying, just to be clear, that their non-COVID product operational revenue growth, that they are not changing that. So this does appear to be tied almost completely to the COVID-related business. We should point out, you're seeing an 8% move down in Pfizer. Pfizer does not move 8% typically. So this is a huge outsized move for a company of its size. We should point out that some of its peers are also being dragged down by this. Moderna down more than, I believe, 3% here in after-hours trading as well.
Yeah, we'll continue to watch for any other follow-through. BioNTech also down more than 4% in the U.S. post-market as well.
Okay, we want to pivot away from corporate fundamentals and, of course, back to politics and geopolitics. Pleased to say standing by right now is James Lucier. He's a founding partner and senior political analyst over at Capital Alpha Partners. Jim, thanks for joining us here. And I want to actually start in Washington first before we sort of broaden this out. There's been a lot of developments and lack of developments when it comes to the speakership situation in the House of Representatives. And, of course, the big concern here is that if this is protracted, meaning this absence of a permanent speaker, when does this become an issue for getting a budget deal, which last time I checked, they need to get done in basically about a month's time?
Well, Romaine, you're certainly right to ask how long this is going to last. The data point we got this afternoon suggests that it will last some time longer. In a test vote this afternoon, literally just a few minutes ago, the Judiciary Chair, Jim Jordan, fell 90 votes short of what he needed to be elected as Speaker, and that suggests he's got a long road to hoe ahead of him. I wouldn't worry too much about this. I do think that there is a backup strategy, which is moving to make the Speaker pro tem a longer position, essentially give him more time as Speaker pro tem for a month to the end of the year, maybe the end of the session, and also the special powers that he would need to move appropriations bills. And frankly, I think it's much better to have a Speaker pro tem in place with respect to avoiding a government shutdown, which is going to be very hard to avoid, and getting the funding bills done by the end of the year. I'd rather have Speaker pro tem than Jordan, frankly.
Well, I am curious, though. I mean, based on some of the reporting that's out there, including Politico and the Wall Street Journal, it seems like the terms of any potential deal to let McHenry continue in that role, while it would expand its powers, he wouldn't necessarily have the full power of that McCarthy or any other speaker would have had.
That's correct. You're looking at a speaker substitute. You're looking at an interim speaker who would be given a limited set of powers. But still, right now, the Speaker pro tem has extremely limited powers, literally nothing beyond conducting the next election. So in the event that we were to see a continuing resolution come over from the Senate with aid to Israel, aid to Ukraine, other things attached to it, then it would be likely, I think, that McHenry would be able to preside over that and at least keep the government running or keep a short shutdown as short as possible. But of course, the big heavy lifting, doing appropriations bills and such, that is really what you need a speaker for.
Right.
And that's why it's...
No. I wanted to follow up on that point. A continuing resolution would allow us to fund the government, but does it address some of those aid concerns that we've been talking about, whether it's for Ukraine or for Israel?
Well, when I was a young man, continuing resolution meant a clean CR with none of this other stuff attached. It was considered tacky to put things on a CR, but of course, in these days, we put supplemental spending bills on CRs all the time. The real issue, I think, is going to come later, especially with regard to defense spending. Jim Jordan's main strategy is to essentially keep all appropriations bills on hold until the end of the year, and we get into that sequester period that is established by the Fiscal Responsibility Act, the FRA, when you have no government shutdown but go to an automatic across-the-board cut of 1% from the FY23 levels. And for many of Jordan's persuasions, that's a policy victory because you're cutting spending big time. But it's going to be very serious for the defense industry, I think, and it's going to put a lot of pressure on Congress to struggle over the next couple of months into next year to try to get the full FY24 funding that many members want.
If that's Jim Jordan's strategy, is that the strategy of those who opposed Kevin McCarthy's status as Speaker of the House as well? I mean, is there enough support for that to move forward?
Well, the strategy, I guess if you can say that McCarthy had a real strategy, it was to play for time and start conferencing individual appropriations bills that you at least some of them, and you could avoid an omnibus situation where ultimately the House is rolled. The House is forced to take a much larger bill from the Senate. So McCarthy would have done bills one at a time and would have limited that and maybe even wrapped things up and managed to negotiate through the end of the year, or so he hoped. Jordan's strategy, as outlined in the conference meetings, is what he said, is really to rely on that sequester mechanism next year to put pressure on the Senate, to put pressure on other members to accept a smaller level of spending than many of them would like to see, but something much more consistent with Jordan's basic desire to freeze spending in FY23 and, in fact, even cut from there.
All right, Jim, great insights. Jim Lucier there, founding partner and senior political analyst over at Capital Alpha Partners. When we come back after the break, we're actually going to hear from Greg Fleming, the CEO over at Rockefeller Capital, and get some his thoughts about the geopolitical uncertainties that have been impacting investors as of late. That conversation up next. This is Bloomberg. A flurry of headlines crossing the Bloomberg terminal involving Pfizer. The shares of Pfizer down 7% in after-hours trading. The company cutting its full-year forecast by more than half of what it had guided to just prior. A lot of this seems to be tied to a slowdown in its COVID-related businesses, particularly when it comes to Paxlovid. Let's get some insights out of Naha Katan joining us to talk a little bit more about this. And Naha, I was going through the statement, and I was also going through some other headlines. Some of this does seem to be tied, I guess, to the main healthcare program here in the U.S. that's going to stop coverage of Paxlovid for non-insured people. But Pfizer also made it clear in this statement here that overall, the revenue generation from some of these treatments related to COVID has basically dried up.
That's right. We're seeing that, there was a very large stockpile of government purchased medicines that were just not being used. We've seen demand for COVID products falling. And so what Pfizer has said, what they've announced is that they're going to have the government return 7.9 million courses of treatment of Paxlovid. And so that those treatments can then be used for to support a patient assistance program to provide Paxlovid free of charge to federally insured patients through 2024.
So clearly this is a surprise, given that the stock is down more than 6% in after-hours trading, and Pfizer's disclosing this Friday after the market closed. Why is it that no investor was anticipating this? Had Pfizer ever dropped any hints about this?
They've been saying for a few weeks now that they don't know, or there's uncertainty about when they would be able to launch in the commercial market, because there was so much inventory in the government's hands. They had millions of pills still in the government's hands. So they were beginning to hint towards it, and there were some analysts who have written notes about the inventory issue.
All right, Naha Katan, taking a look here at some wild trading here on aftermarket trading on a Friday afternoon. And of course, if this were during the cash session, this would actually be one of the worst drops in Pfizer's history here. We're going to keep an eye on that headed into the week. And remember, we don't actually get the full results out of Pfizer until the end of the month. Greg Fleming, Rockefeller Capital CEO, that conversation after the break. This is Bloomberg.
All right, the U.S. House of Representatives has left for the weekend because the Republican conference was unable to elect a speaker. But according to Congressman Michael McCall of the Republican Party, the House does plan to vote on a speaker on Tuesday. Jim Jordan, of course, was nominated as a speaker, but it's a long road for him to actually win the speakership. Romaine, I'm going to send it over to you now.
All right, just a reminder, Scarlett, I think here of just how much politics is dominating what the investors' decision. David Weston joining us right now for our Wall Street Week Daily segment. And I think you had a chance to catch up with somebody who had that to say.
Yeah, exactly right. Yeah. Greg Fleming is the president and CEO of Rockefeller Capital Management. They manage about $112 billion for high net worth and ultra high net worth people. So we asked him, what are his investors, what are his clients really concerned about right now, particularly given what's going on in the Middle East? And we started on geopolitics, then moved on from there.
Investors, David, have a hard time measuring geopolitical risk. And history would suggest that a lot of the immediate downturn that occurs on the back of different geopolitical events tends to reverse over the following months. So the big issue in a place like the Middle East today for investors is, does it expand? Will it move into a regional conflict, bringing in nation states like Iran and then ultimately impacting things like the price of oil that would have an impact on the global economy. If you look at local markets in the Middle East today, they've had a fairly moderate reaction, down a little bit. The Israeli stock market in Tel Aviv was off the first day, but has been in a range since, so that even the local players so far are measured in response. But our investors here in the U.S., no fundamental change at this point in time. Other than sitting here and witnessing these unimaginable horrors that the rest of us are watching. From an investment standpoint, they're similar to where they were before this.
When you talk about fundamental change, we've seen a fundamental change in the rate structure. We were essentially with free money for an awful long time, essentially zero rates. Those days are gone. It looks like we're going to have higher rates for some time to come. How do your investors take that into account?
Well, that's a big impact on investors, and that's something that they're all digesting. So, at the outset, when you look at stocks and stock markets, the risk premium that stocks bring today now over other attractive alternatives, even cash, but munis, treasuries, things like private credit, which is a big growth area for us within our alternative business, that risk premium is down on equities. The reality is, with higher rates, growth companies, you're discounting back cash flows that are out there in the future that are going to grow between here and there. You're discounting them back at higher rates. So from an equity market standpoint, the higher rates are a serious headwind, particularly when you have the kind of alternative uses of investor dollars that we're seeing. And as I said, even cash. If you can get 5% on a risk-free basis in something that liquid, that presents a positive alternative for investors. The other thing I would say about higher rates is the impact from a fiscal standpoint, which I know you spent a lot of time looking at. On the current trajectory, interest payments on the federal budget will exceed military expenditures by 2027. So higher for longer has a big impact on the fiscal side of the equation, which is relevant to all investors because the U.S. debt situation is definitely a concern.
And what overhang might that have for growth? Because your investors must be thinking about what are our growth patterns? What are we looking at over the next 5, 10, 20 years?
Well, the U.S. economy is held in remarkably well. There's a number of reasons for that, including the fiscal spending. I mean, we're running a federal budget deficit now of 8% of GDP, and there is no recession. Typically, deficits go up when you have a recession. If we have a recession, you could see a double-digit deficit as a percentage of the federal budget. So with that kind of fiscal spending already embedded in the economy, will there be enough growth for investors in the U.S. market? It's a real concern that the fiscal side of the equation could be a headwind for investors going forward. So you have that investors are focused on. And then you have the Fed, who's obviously been raising rates to try to deal with inflation. Those higher rates are also working their way into the fiscal situation. So you have a headwind on the monetary policy side. You're likely to have an increasing headwind on the fiscal policy side. So investors look more cautiously at the medium-term outlook for the U.S.
Your high net and ultra high net worth investors must be thinking about taxation. And when you talk about the fiscal challenges we have in front of us, one possibility is higher taxes to raise more revenue. How do you invest around that potential?
One of the things that we do with our investors is we work with them on a comprehensive basis across all of their needs. So we're helping them with generational work, we're helping them with estate planning, and already, even if taxes don't go up at some point in the future here, already you have tax cuts in 2017 that are scheduled to expire at the end of 2025. So we're spending a lot, and the estate deduction, the ability to leave money without paying an estate tax, that amount is coming down if those taxes are rolled back. So we're already spending a ton of time with clients on a longer-term basis looking at tax policy from that vantage point. So taxes are a big part of the work that we do. We have a group called our Wealth Strategies effort that works very closely with our private advisors and our clients on pre- and post-tax planning.
That is Greg Fleming of Rockefeller Capital. He's the CEO and president there. In addition to Greg, we're also going to talk tonight to Richard Haas, formerly of the Council on Foreign Relations, about what's going on with possible invasion of Gaza. And we'll talk to Larry Summers about that dust-up at Harvard over a position on Israel. And then finally, we'll talk to Kathy Marcus of PGIM Real Estate about the real estate market. That's all coming up at 6 p.m. Eastern Time on Wall Street Week.
Definitely tune in for that. And, of course, David joins us every day here on The Close for our Wall Street Week daily segment, helping to wrap up our coverage coverage on the close on this week. It's been, of course, a very wild week in markets. Scarlett, Katie and I will be back next week on the close, but please stick around here. After our show, Balance of Power is coming up next. They're going to have full coverage of everything going on with the situation in Israel, as well as what's been going on in the House of Representatives, and Wall Street Week, of course, on tap after that. Have a great weekend. This is Bloomberg.